Okay, so if I'm not mistaken, your final is next Saturday, so it's coming quickly. Okay, my screen is sharing. Sorry. Do you guys see the PowerPoint or you see the questions? Okay, thank you, because I have a weird message. Okay, so the final is next Saturday. My best tip is to practice past finals. There's probably some that are posted on Moodle. We're doing past final questions right now during the tutorial. And also, if you want to do more problems, all my previous tutorials are all past final questions. So there's a bunch that's available to you guys. Oh, exam is Friday. Thank you for correcting. Exam is Friday, so a day less. I guess like your midterm, you probably notice it's less focused on theory. You need the theory to do the problems, but they're not gonna ask you to write something that's in the IFRS norm, word for word. They're more gonna test your comprehension of the theory through problems. Of course, the big monster of your exam is gonna be chapter 18. Try and understand the logic behind it, even though it's a little bit more complex. I'm going to give you guys some tips and tricks for chapter 18 that hopefully is going to help you out on the exam if you're having difficulty with it. And yeah, so how I'm going to do the tutorial is I'm going to start with the theory for each chapters, and then we're going to do the problems associated with each chapters, and then repeat theory problems, etc. So the first chapters that you're going to send your exams are for chapter 15 and 17, which are about equity and earnings per share. They're often tested together in the long problems because they kind of go hand in hand. For chapter 15, it's about shares and dividends. So equity, there's two big accounts that comprise equity. It's going to be your share capital and retained earnings, which is basically your where your profit and loss goes every year and accumulates. Share capital is what the shareholders, the owners of the company own. So an owner in a company is going to own shares, and the amount of shares that they own is going to be the amount of the company that they own. There can be different types of shares, but the most basic one is common shares. And there can also be preferred shares that comprise the share capital account. These preferred shares have different features to them where someone's going to want to pay a little bit extra money to own them. In each of their categories, so each common shares is exactly the same as every other common shares. Each preferred share of each category, so you can have preferred share A, B, C. Every preferred shares are in category A is going to be exactly the same as the other preferred shares in category A. So to calculate the percentage of ownership of a company, you're going to go about how many shares does the person own versus how many shares does the company have in total. And then you just do the number of shares that the person owns divided by the total amount of shares in the company. And that's going to give you the percentage of ownership of the person. So some few things that you should know about common shares for your exam. Someone that owns common shares are not guaranteed dividends every year, and they have input into the company. They can vote in shareholder meetings. If the company only has one category of shares, it's going to be common shares. That's the one category of shares that is everywhere. Then you have preferred shares. Not all companies have it. They have preferential rights attached to them, which are going to give them special benefits. A type that you should know is cumulative rights. So every year there might be dividends or not that are declared within the company. If the company has cumulative preferred shares and dividends are not declared during the year, the holders of cumulative preferred shares are still entitled of the dividends that they were supposed to have for that year. So that means that in future years, when dividends are declared, they're going to be the first one to get their dividends for all the years that they didn't get it in the past. So let's say we're in 2022 right now. Dividends are declared for the year 2022. Preferred shareholders didn't get, cumulative preferred shareholders didn't get dividends in 2021. So you're going to first calculate the dividends for the 2021 year for the cumulative preferred shares. And that's going to be the first amount that you pay out, regardless of all the different classes of shares that you have. And then whatever's left over is going to be attributed for the 2022 year. Dividend scenarios can be for 1 year, can be for multiple years. It really depends on the situation of the company. You don't have to record a liability every year for cumulative preferred shares. You also have convertible preferred shares, which means that your preferred shares can be converted into common shares at an amount that's defined by the company. You can have multiple classes of convertible preferred shares, which are all convertible into different amount of common shares. You also have participating preferred shares. So if a preferred share is non-participating, so they don't have that feature, that means that they get their dividends first during the year, whatever amount that they're entitled, and then the leftover of the dividends that was declared is all attributed to common shareholders. If the preferred shares are fully participating, that means that they're going to get first their little amount of dividends, and then the leftover that was before all attributed to common shareholders now is going to be weighted, and the fully participated preferred shareholders are going to get the same amount percentage-wise as the common shareholders based on their book value. So let's say they get first a 5% dividend, that's out of the way. Then you're left over with $100,000 of dividends. You're going to look at the book value of the preferred shareholders, the book value of the common shareholders in the equity section. And then you're going to say, okay, the $100,000 left over of dividends, I want it to give the same like percentage dividends for the preferred shares and the common shares. It's a little bit difficult to explain just with words, but we're going to see how that's calculated into the when we're doing the problems. And you can also have partially participating preferred shares, which means that the preferred shares first get their dividends, then common shareholders are going to get a dividends too that's only attributed to them at a certain rate or percentage. And then whatever's left over after that dividends to the common shareholder is going to be split between the preferred shares and the common shares as if it was fully participating. When shares are issued, they're first going to be authorized by the board of directors. Then they're going to be put onto the market, and people are going to, and then the shares are going to be issued. You can have issuance costs when you're issuing shares. These issuance costs are going to come and reduce the amount, like your book value of your common shares and your cash amount that you're going to receive from the issuance of the shares. So in this example here, there was $100 in issuance cost, and the total market value of the shares when they were issued was $5,000. So the journal entry that the company did was 5,000 minus $100, and that gave them common shares issued for 4,900. You can have shares that are sold on a subscription basis. That occurs when like there's new small companies that go public and they want to receive like a small portion of the cash in advance, but they're not necessarily ready yet to issue their shares. When a share is sold on a subscription basis, you don't receive immediately the full market value of the shares that are going to be issued, but you also don't issue yet the full amount of shares. The shares are only issued when the full payment is received. For example, I've put like the journal entries for an example. We're going to do one in the problems. Also, just a note, all the PowerPoints are already on the Facebook group. If you look under the Files tab, you can find everything there. A point to note, in the journal entries, you're going to set up a subscription receivable account. That subscription receivable account is not an asset. You would think it is because it's receivable, but you don't want to have an impact on your equity up until you issue the shares, which is going to be at the end when they receive the full payment. So the subscription receivable is going to be a contra equity account, a little bit like how allowance for doubtful accounts is a contra asset account where it reduces your assets. This comes and reduces your equity so that the impact of this transaction is going to be zero because this is also an equity account. This is just to present fairly the balance sheet and the financial statements. You don't want to have any impact on equity. So if they ask you that in your exam, well, there it is. And then, so this is they receive a payment, cash, they receive another payment, which was the final payment, and then the common shares are finally issued, and that comes and reduce the common shares subscribed account that was originally set up here. If within the time frame of the subscription contract, there's some people that say, never mind, I paid you some amount, but I don't really want the shares anymore. The amount of money that the company has already received for that contract can be treated three ways. They can either return the money to the subscriber, so the amount that the subscriber has already paid for those shares, they just refund it. They could treat it as, okay, well, I'm just going to keep the money and don't give you anything. And they could also issue fewer shares for the amount of money that was received. So it could either go as a reduction in cash. It could go, so that's if they repay the subscriber. It could go in a contributed surplus account, which is going to impact your equity, or they can issue fewer shares, which is going to impact your common shares account if it's common shares that are subscribed to. So in this case, yeah, so that would be like the kind of journal entry that you would do, either contributed surplus, cash, or common shares as a credit. A company can also decide to buy back their shares from on the market. There can be multiple reasons why they do it. One of them it would be to return cash to shareholders, make a market in the share, increase EPS, a bunch of different reasons. When that happens, the book value of your shares is not necessarily the same value as the market price of your shares. So there's going to be some difference within the two. And how that difference is treated, it's not a gain or loss necessarily. It can impact a few different accounts. Under ASPE, how you're going to treat like that difference is, first of all, you're going to buy back your shares on the market. So that's going to be like your cash account as a, okay. So when you buy them back, you're going to go on the market, buy them at the market price. So that's going to reduce your cash for the market rate. Then you want to come and reduce your common shares in your book. So you're going to reduce them at your book value. Difference between the two is going to first be attributed if you have the account in your balance sheet already to a contributed surplus account for repurchase of the same class of shares. So that would be the first one. If you still have leftover of that difference, after it's going to be attributed to a contributed surplus account for any other type of contributed surplus that touches the same class of shares that you just bought back. And this instead, it was a contributed surplus on options, but it was for the same class of shares. And then if you still have leftovers, it's going to come and reduce your retained earnings. So that is going to come as a loss in your equity. So it doesn't touch your P&L like other like gain and loss transaction would do, because it's all within equity. So you want to keep it in equity. That's under ASPE. IFRS, you don't really have any guidance on how to treat it, but you can follow the same as ASPE for your costs. So just keep in mind that it's contributed surplus repurchased for the same class of shares, then contributed surplus, any type of contributed surplus, but for the same class of shares, and then retained earnings. For the dividends, most common are cash dividends, where they give back cash to their shareholders. Dividends are voted and declared by the board of directors of each company. And when they are declared, it's going to come and reduce your equity and also create a liability as a payable. Before the dividend is paid, the company is going to have to check who are their shareholders, who do we need to pay. So a list is going to be prepared. That's not going to impact your accounting side of things. This is more of an admin thing. So you're not recording any journal entry when the list of shareholders is prepared. And then when you make the payment, you're going to come and remove your dividends payable from your book and actually pay it out with cash. So a little example, you first have your declaration where you set up your dividends and dividends payable. When you check for the list of shareholders, no entry. And then at the date of payment, you reduce your dividends payable and reduce your cash that you paid out. You can also have dividends that are paid out in other assets than cash. Thing to note is that the value of that dividend is going to be at the fair value of the asset that is given up. So if I'm giving a dividend of a building, the value of that journal entry is going to be the fair market value of the building, not the market value of the shares. And you're not recording any gain or loss if there's a difference between the market value of the shares and of the asset that you're giving up. There's also stock dividends, where as a dividend, you're giving more shares. So you're giving the same amount of shares to everyone. So for example, if there's a 10% stock dividend, everyone's going to receive 10% more shares than what they had previously. So it increases in total your number of shares by 10%, but it's not going to come and impact the percentage of ownerships of your shareholders, because everyone is receiving 10% more. So the percentage of ownership doesn't change. The journal entry is going to be the number of shares that you're issuing, so 10% more shares, so 10% of your current number of shares times the market value of the shares that you're issuing. So how you're going to set it up, at the date of declaration, you're going to have your dividends account, stock dividends distributable. So that's in the meantime before the common shares are issued. And when they're actually distributed, so think of it as when they're paid out, you're going to issue your common shares and reduce your stock dividends distributable. This transaction doesn't impact your equity because the two accounts are within equity. So net impact is 0. You're going to really have an impact in your equity section at the date of declaration. When you're paying out dividends, there's a order that you have to follow. So first, you're going to pay out the dividends in arrears for cumulative preferred shares. So that means if there was 3 years where you didn't pay any dividends for your cumulative preferred shares, you're going to pay them first. Then you're going to pay the current year preferred share dividends, then your common share dividends. And if the preferred shares are participating, you're kind of going to calculate it at the same time as point number 3. You can also have stock splits. You're not going to have any journal entries, but in your exam, that's going to impact your basic EPS calculation. Well, just your EPS calculation in general. So stock splits are when a company decides to issue more shares, a little bit like a stock dividend, but not really. If they do a 2-for-1 stock split, for example, they're going to double the amount of shares that they have. So every shareholder now has double the amount of shares, but it doesn't impact at all like the money amount. There's no journal entry that you're doing. There's no like issuance of shares. You're just doubling the amount of shares that is in the books of the company. So if I had 100 shares, I now have 200 shares, but the value is not the same. So your value per share decreases because you now have more shares, but for the same amount of money, if that makes sense. You can also have reverse stock split, where it's the reverse of what I just said. So if it's a 1-for-2, if I had 100 shares, I now have 50 shares for the same amount of money. That's it for chapter 15. Any question on the theory? Because I feel like I went fast, but I'm gonna like go through it again in the problem for like the most important things. All right. For chapter 17, earnings per shares, the objective is to let common shareholders know how much of the company's net income is available to them. So if I have 100 shares, how much can I earn from the company with my 100 shares? It helps them assess like how much in dividends they're going to have. It can help them assess how much does my shares like are valued at. Yeah, so it's the amount of income that is earned by each common shares. The basic EPS formula is your net income after tax minus the preferred share dividends. We remove that amount because that is not available to common shareholders. So they're never gonna access that money. If there's no dividends that are declared during the year, you still have to remove the cumulative preferred share dividends because eventually these are gonna be paid out in the future first. So that amount of money, common shareholders are never gonna touch because it's always gonna go first to the cumulative preferred shareholders. So basic EPS is the actual earnings and the actual number of common share outstanding based on the financial statement. Diluted EPS is another calculation that is more like a what if that takes into account the possibility of different financial instruments that could impact the common shareholders and the number of common shares that are in the market. For example, we talked earlier about convertible preferred shares. Well, these convertible preferred shares can be converted into common shares. So what if they get converted? What would be the impact to the common shareholders if they get converted? Is it going to increase the EPS? Is it going to decrease the EPS? That's what we're trying to figure it out. So the diluted EPS is like the worst EPS possible for common shareholders. Like that's the minimum value that each common shares is worth. EPS disclosure, you need to disclose it for all peers that are presented. If there's a stock dividend or split, okay, that's a good point. If there's a stock dividend or a stock split, that's going to impact your common share balance. And you need to like restate all previous periods with that stock dividend or stock split. So if I did a 2-for-1 stock split, I increased my current balance by, I doubled it actually. I have to double all previous years and previous like comparative figure by, I need to all double it because I want it to be, you want to be able to compare it. And since the only impact is doubling the amount of shares and not necessarily the value of it, if you're not doubling your previous year's figures, you're not showing it correctly. You're not really comparing it, what's the word? Accurately. So you need to restate all the numbers. When the results has been restated, yep. If you do diluted EPS 1 year, you're gonna have to do it in the future forever until it goes bankrupt and you're not issuing financial statements anymore. Okay, that's what I just said. So if there's discontinued operations, you're gonna have to present the EPS before the discontinued operation and for and after. No, sorry. Yeah. So discontinued operation, income before discontinued operation, that's the basic EPS. That's the basic EPS for discontinued operation, and then you get your net income, and then you get that's the basic EPS for your net income. So you have to show it for all three amounts. And same thing for the diluted EPS. So the financial securities that we're looking at into when we're calculating the diluted EPS are convertible preferred shares, convertible bonds, because they can also be converted into common shares, then options and warrants that can, if exercised, are going to impact our common shares amount. So how you go about calculating your diluted EPS, you first have to have your basic EPS. Then you need to calculate the incremental EPS effect of each securities. So that means, I think it's easier if I do it this way. You're going to calculate the income effect of each security and then the share effect. Income effect is if it was to be converted, how does it impact my income? That impact is what you're going to use in your income effect. And for the share effect is if it gets exercised or converted, how many more shares are on the market. Divide your income effect by your share effect, and then you get your incremental EPS. That's going to give you a number. If that number is higher than your basic EPS, then if they get converted, your common shareholders are in a better position than if it doesn't get converted. So they don't really care about that. If it's lower than your basic EPS, you want to include it in your diluted EPS calculation. So you're going to keep it there. You do that for each security, and then you're going to rank them. The lowest incremental EPS is your rank 1. And then after that, your second lowest is your rank 2. Your third lowest is your rank 3. And when you're going to calculate your diluted EPS, you're going to start from your basic EPS, take your rank 1, add it to your basic EPS, see is the EPS I get now still lower than my basic EPS? Yes, I keep going. If at one point one of the securities increases your EPS that you're calculating, then that becomes anti-dilutive, and it means that basically it's not the worst EPS that you can get. It comes and increases it, so it's not the information that we're trying to find. And that's it for chapter 15 and 17. So for the problems, I'm going to share my other screen. This one. Okay. Okay, so you should now see the problems and an empty Excel sheet. Where's the chat? Perfect. So the first question is about chapter 15. Stable Pipelines Inc. reports the following items in shareholders' equity as at December 31st. Their preferred share capital has 15,000 authorized and 4,000 issued shares in 2015. $60 dividend participating after a 30 cents per share common dividend is received by common shareholders, and their total book value is $36,000. The common share capitals have authorized 200,000 shares, and there's 92,000 shares outstanding for a book value of $1,080,000. They have contributed surplus on share retirement of $17,000 and retained earnings of $4.3 million. The following transactions and events happened in 2019 in chronological order. A cash dividend of $42,800 was declared and paid. Dividends were last declared in 2016. Assume that the preferred shares were cumulative. There is a 4,000 common shares that were issued for land. The land was valued at $60,000. Recent trading activities indicated that the market value of the shares was $18.75 per shares. A 10% common stock dividends was declared and the shares were issued. Common shares were being traded at $26.78 for the dividends when the dividends were declared. 10,000 common shares were subscribed for at $23 per share. All subscribers paid the first installment of $4 per share on application. The second and final subscription installment was called. 9,200 shares were paid in full and issued. The remaining 800 shares were not paid by the subscriber, and the company treated their earlier payments as forfeited. In 2015, the company had issued 2 million. F we're not going to do because it's about chapter 14, so it's not going to be in your exam. So the first requirement is determine the amounts to be distributed to each of the two shareholder groups as cash dividends using the information given in the problems. So the cash dividend that was declared was of $42,800. So we're looking at A here. What we want to find is how much was attributed to preferred shares and how much was attributed to common shares. Hold on, I'm just setting up my Excel so it's not like crazy when I type. Okay. So it says in A that the preferred shares were cumulative. So we want to know first, do we have dividends in arrears? It says that the dividends were last declared in 2016. So that means in 2016, they got their dividends. 2017, they didn't get it. 2018, they didn't get it. And we're now in 2019. So there's 2 years in arrears that we first need to pay out. How we calculate the amount of dividends is going to be the number of shares, outstanding shares. So in the case of preferred shares, there's 4,000 shares. Then we want to see what's the dividend rate. And in this case, it's 60 cents. And then we do times 2 years. So 4,000 shares times 60 cents times 2 years. So we did our in arrears. So now we want to do the dividends for the preferred shares for 2019. So for this year. And that's going to be just 1 year of dividends for the preferred shares. So it's going to be the same calculation as here as the 4,000 shares times 60 cents. And then it's going to be time 1 year. So $2,400. Then we're going to look at our common shares, how much dividends that they would get. The preferred shares are partially participating. So it says here that they're participating after a 30-cent per share common dividend is received by common shareholders. So we're going to first attribute it, the 30-cent per share common dividend, to the common shares. So I'll do common shares. So that's going to be 30 cents times the number of shares outstanding for the common shares, which is 92,000. So that gives us an amount of 27,600. Now we want to see, do we still have a balance left over? Technically, you should do that after every step, but do we still have an amount of dividend, cash dividend that we still need to split between the two? So we still have a balance left over of 8,000. So that 8,000, I want to split it equally between preferred shares and common shares. And when I do equally, it's not like they're gonna both get $4,000. I want to weigh it on the book value of each and get the same percentage dividend to each. So that means that the preferred shares, based on the book value, they got the same percentage of dividend as the common shares based on their book value. So the book value of preferred shares is 36,000. And the book value of common shares is 1,080,000. So, for example, let's say that it gets to, I want a 2% dividend of 36,000 and a 2% dividend of 1,080,000. And the two together should equal 8,000. How we find that is by doing, I always forget how it's called in English, but in règle de trois. So you're going to do your 8,000 times your 36,000 divided by the sum of both book values. And you're going to do the same thing with the common shares. So I want to do the 8,000 times the 1,080,000 divided by the sum of both here. So basically a weighted average, I guess. I've been out of my bachelor's for a while. I'm forgetting my terms. But the sum of both gives 8,000, which is the amount of excess. So now we have no leftover to distribute. Okay. We have completely attributed our $42,800 to both the preferred shares and common shares. So that gives us a total amount of 7,000 dividends to the preferred shareholders and 35,000 to the common shareholders. So that's it for 1. For 2, assume for A above that the preferred shares were non-cumulative, determine the amount. So basically the same thing, but the preferred shares are non-cumulative. I'm just going to copy all of this here. So I'm going to remove this row here. I'm first going to look at my preferred shares amounts. Dividend amount is going to be the same thing as what we calculated here for the 1 year. Then I want to look at, okay, what is my common share dividends, which is still the 30 cents per shares. So that amount is not going to change. The amounts that are going to change is these two here. So I just want to make sure. Okay. So here we have a leftover amount of $12,800. So that $12,800, we want to attribute it weighted equally between the preferred and common shares. So how I'm going to do that, I'm going to take my 12,000 times the 36,000 book value of the preferred shares divided by the total book value of both shares. So that gives us a dividend of 413 that we add to the mix, and then do the same thing for the common shares. So 12,000 times the 1,080,000 divided by the sum of both book values. And that gives us an amount of 12,000. If we add both together, that gives us our excess, and a total, if we do the sum of all of those, that gives us our total cash dividend that was declared of 42,800. Then they ask us to prepare the journal entry for B, C, D, and E. F, like I said, is not going to be tested. I think that was an assignment. That's why it's there, but you're not going to get a question like this in your exam. So for C, a 10% common stock dividend was declared and the shares were issued. Common shares were being traded at $26.78 when the dividends were declared. So for the stock dividends, well, they were declared, so it's gonna impact your dividends. And then since it was declared and the shares were issued, you're gonna go straight into your common shares account. If it wasn't, it would have been like the one that we saw in the PowerPoint that was like common shares distributed or something like that. And then when it was issued, you would reverse that account and then do credit your common shares. The amount that will be used for the journal entry is the number of shares that you're now issuing times the market rate. So it's going to be 10% of the current balance of shares, which is 92,000, because there was no impact in your equity in A. Oh, wait, did I skip something? Never mind. I skipped B. Okay. We'll keep that in mind. We'll come back to it. We'll do transaction B first because that's going to impact your balance of shares. So 4,000 common shares were issued for land. The land was valued for $60,000. Recent trading activities indicated that the market value of the shares was $18.75 per shares. So now you're issuing shares in exchange for land. So you're going to get a land, you're going to issue shares, and you're going to take the fair market value of your land, which is 60,000. They put the market value of the common shares to trick you, so you use it, and then you calculate a loss or a gain, and then you plug it. There's no gain or loss. You're always taking the fair market value of the asset when that type of journal entry appears. We increased our balance of common shares by 4,000 because there was 4,000 common shares that were issued. So that means that my new balance was the beginning balance of 92,000 plus 4,000. So my balance of common shares is now 96,000. For D, for the stock dividend now of 10%, that's going to come and impact your calculation for the 10% common shares. So you're going to take your book balance, your number of shares outstanding, which is now 96,000. You're going to calculate 10% of that. And then you're going to use the market value of the shares to calculate like the dollar value, which is $26.78 when the dividends were declared. So I did 96K shares times 10% times $26.78, which is the market value. Then for the next journal entry, 10,000 common shares were subscribed for at $23 per share. All subscribers paid the first installment of $4 per share on application. So there's a subscription contract. So you first want to set up that subscription contract. So you're going to have a subscription receivable, which I remind you is contra equity, not an asset account. And then you have your common shares subscribed, which is an equity account. The amount is going to be 10,000 shares times $23 per share. So the amount that's on the contract. Then on the same day, they also received the first payment, which is $4 per share. So it's going to come and increase your cash and reduce your subscription receivable. So it's going to be $4 times the 10,000 shares that were subscribed for. Then for E, I guess requirement 6, the second and final subscription installment was called. 9,200 shares were paid in full and issued. The remaining 800 shares were not paid by the subscriber, and the company treated it their earlier payment as forfeited. So that means that at the beginning, the contract, there was 10,000 shares that were supposed to be issued. There's 800 shares that they decide, well, the people holding that contract decided, no, never mind, I don't want it. I don't want the shares anymore. So the company treated it as forfeited. So they're not going to issue shares. They're not going to pay them back. They're just going to take the money and go with it. So the journal entries are going to be, we're first going to do the cash that they receive for the 9,200 shares. So it's going to be the same journal entry as for the first, payment. But now it's going to be with 9,200 shares instead of 10,000. There was already a $4 payment that was received. So the balance to be received is $19 to get to the $23. So it's going to be times 19. Times 23 minus 4. So that's full payment, well, second payment of 9.2K shares. Then for the 800 shares that were forfeited, you're going to want to come and reduce your common shares subscribe it account. You're going to want to reduce your subscription receivable account. Receivable. And the difference between the two is going to come and go in your contributed surplus or forfeited subscription account. Your common share subscribed or account is the 800 share value of the first journal entry you did. So it's going to be 800 shares times $23. So the full amount that was subscribed for. Your subscription receivable is going to be the leftover amount that you were supposed to receive for the 800 shares. So it's going to be 800 shares times, there was only a payment of $4. So the leftover is $19 per share that you were supposed to receive. And then here, the amount is the amount that you already received. So it's 800 times $4. So 800 times 23, 800 times 19, and then 800 times $4. And then your last journal entry is going to be for the issuance of the 9,200 shares. So you're going to issue your shares, so common shares as a credit, and then your other account is your common shares subscribed for account that you want to bring to 0. So here it's going to be 9,200 shares times $23. Same thing here. Another way you can find this amount here is you take your amount that you credited in your first journal entry minus the amount that got forfeited for your 800 shares, and you get the same thing. Oops. Shares times $23. That's it for the first question. Any questions on this?
Yes, Florence, I don't know if you can you hear me? Okay. So
Yeah.
for the forfeited portion, that means that we're not going to give it back, correct? So
Yeah.
then wouldn't the balance be the $19, like the check, wouldn't that be at the $19 per share?
The only amount that you've received is the $4.
Is the $4, right?
Exactly.
Okay.
Your $19 comes in your subscription receivable because that's the amount that you haven't received yet. So you're not going to receive it, so you want to remove it from your books.
Okay, so then can you just re-explain that last check that you said about how to check that the common shares subscribe and the common shares are the
Yeah,
right
here,
amount?
this amount here.
Yeah.
Yeah. So there's two ways you can calculate it. If there's like nothing weird like a forfeited subscription or anything, it's basically going to be the amount of shares that you're issuing times the amount that's on the contract. So in this case, you're issuing 9,200 shares and the amount of the contract is $23. If you want to like double check that you calculated right, and there was like forfeited subscription, you can just
Mhm.
take the amount that you set up at the beginning. So your credit
Yeah.
account, your credit amount of your common share subscribe, and then reduce it by your debit in your previous entry. And you should get to the same amount.
Okay. Okay. Yeah. That makes sense now.
Yeah.
I didn't know if we had to take the $19 instead, since technically we've already like used up that. Well, we're going to keep that cash, right? From the $4.
Yeah, exactly.
Okay. But then it goes to contributed surplus. So it's a different account. Okay.
Yeah,
That works.
it like how you're gonna see it's like it increases your equity, so it's like a gain. It's the same impact as a gain in your financial statement. It's just that it doesn't go in your income statement, it goes straight to equity because it's shares transactions.
Okay. Got it. Thank you.
No problem. For question 2, there is a good bit that we've already covered in question 1, mainly the subscription shares. So I'm not going to cover it, but because it's exactly the same transaction that we just did. But if you want to see it, it's in I'll copy and paste the solution so you have it and you can check when you practice. And it's in the chapter 15-17 tutorial for winter 2022. I'm gonna cover the rest of it though, because I think it's different transactions than what we saw in question 1. Sorry if you hear background noises. So on June 1st, the company issues 8,000 shares in exchange for land with a fair market value of 160,000. So, and then they asked to do like the journal entry for each date. So I'm just gonna do straight up the June 1st journal entry. So that's the same thing as what we saw in question 1. You're gonna debit your land, credit common shares, and the amount that you use is always the fair market value of your asset, which in this case is 160,000. You issued 8,000 shares. Just so we keep it in mind for the future journal entries. On June 30th, it repurchased 50,000 shares at $16.80 and canceled them. So on June 30th, so they repurchased 50,000 shares and canceled them. So it's the one where we go and check what's the difference between my market value and my book value. And that difference is going to be attributed to different contributed surplus accounts if you have them. And then the leftover excess is going to go and debit your retained earnings. So in this problem, if we read it all, here we have like the different types of transaction we're going to do. And then here we have on January 1st, the company carried an opening balance of 115,000 in its contributed surplus share repurchase account. Further, the company had no remaining shares outstanding on that date. So that means that we have one account of contributed surplus shares repurchase with a balance of 115,000. So if we have an excess, we're going to want to attribute it first to that account, and any leftover is going to go to retained earnings. Another thing that we want to know is what is the book value of our shares. To find that, well, here we had issued shares. So I'm just going to do like the portion that is attributed to the subscription because I have it, but technically you would have calculated it in A, B, C, and D. So the dollar amount is going to be the 2.8 million here. And then you also issued shares when you issued your common shares in exchange for land. So it's going to be increased by 160,000. And your number of shares is from the subscription, it was 192,000. And then from the land, it was 8,000 shares. So subscription, the impact was 288 million. plus line 160K. You had no beginning balance, so that's the only transactions that impacted common shares during the year. And then the number of shares, you had 192 from subscription plus 8K from land. Okay. So that gives a $1 per share book value of $15.20. So that's going to be used when we want to buy back our shares. So we want to remove from our books 50,000 shares. And they have a book value of $15.20. We bought them back on the market for $16.80. So that's going to be used to calculate your cash amount that you spent on the market to buy them back. So you have a difference between your book value and the market of 80,000. That 80,000 is first going to be attributed to your contributed surplus account. And since the balance of that account is 115,000, the full amount of 80,000 can be attributed to that account. So you're not going to touch your retained earnings. So that's going to be it for the transaction. If there was another contributed surplus account, if there was a retained earning account, and if the balance was greater than 115,000, then you would have attributed the excess to all these accounts. But again, it depends on like the problem that you have. In this case, there was only this account, and the balance of the account completely covered our 80,000. So now the balance of the contributed surplus is going to be this 115,000 minus 80,000. So left over 35,000 in the books. Then there is, on July 15, it declared a 10% stock dividend, and the market price of the company shares on that day was $15.40, and the share certificates were distributed 1 month later. So on July 15, they declared their dividends. So you're going to set up your dividend account. And then your credit account, since they weren't, it declared 10%. So the shares weren't issued at the same time as when they were declared. So your credit account is going to be the, what's the name? Let me check. So it's going to be stock dividends distributable. Distributable, which is an equity account. The amount is going to be your number of shares. Now you bought back 50,000 shares. So before you had 200,000 shares before you bought back your shares. Then you're going to reduce it by 50,000 because you bought them back, so they're no longer outstanding. Your stock dividend is of 10%. And the market rate on that date was $15.40. So that gives a dividend of $231,000. So 200K minus 50K times 10% times $15 and $40. And then a month later, you're going to issue your shares. So you're going to reduce the amount that you set up here for the same dollar value, and then your common shares are going to be issued. So that pretty much covers like all the type of transaction you might be asked for chapter 15. The only other thing that they could like trick you with is to ask for a stock split for you to do a journal entry, but just remember there's no journal entry for a stock split or for a reverse stock split. Yeah, so I had a question that if there's a loss when we repurchase shares, so the market value of the shares is greater than the book value, which is the case here, how would we attribute the loss amount that you would normally book in like a loss account? So, oops, I wasn't pointing on my right screen, but let me just go back to, so your loss, which is basically the difference between the market value and the book value, is first going to be attributed to the contributed surplus repurchased account for the same category of shares. If the loss is entirely covered by the balance in the contributed surplus account, then that's it for the transaction. Basically what happened here in our problem. If you still have a leftover, basically you covered the full amount of that account, your excess is then going to be attributed to a contributed surplus account that is linked to any type of transaction with that share category. So in my example here, it was a contributed surplus that was linked with options for that shares. So you would attribute it to here. If you still have an excess after you attribute it to that, you put it as a debit in retained earnings. So you look first for contributed surplus, repurchase, then contributed surplus, anything that's linked with the class of shares, and then retained earnings. You might not have any contributed surplus at all, so you just put it directly to retained earnings. It really depends on what's given in the problem. Then question 3. Capitals Inc. has a $600,000 90 no par value preferred shares, and they have 60,000 shares and 900,000 of no par value common shares outstanding, 90,000 shares. No dividends have been paid or declared during 2008 and 2009. As of December 31st, 2010, it is desired to distribute cash dividend of $306,000 as dividends. So the required how much dividends will the preferred and common shareholders each receive under each of the following assumptions? So first, if the preferred shares are non-cumulative, if the preferred shares are cumulative and non-participating, and if the preferred shares are cumulative and fully participating. So first, if they are non-cumulative, so preferred, common, you're first going to want to look at, well, they're non-cumulative, so you don't have to worry about about dividends and arrears. So you're gonna go to the current year preferred shares dividends. That's gonna be the first one. The preferred shares have a 90 cent per share dividend. So you're gonna do 90 cents times 60,000 shares. So they get 54,000. And then whatever is left over goes to common shares because they don't have any other features. So it's going to be the cash dividend amount of 306,000 minus your 54,000. And that is the amount of dividends for the common shareholders. So that gives us a total of $306,000 in dividends. If the preferred shares are cumulative and non-participating, you're gonna first want to look at, is there any dividends in arrears? We are currently in 2010, and there was no dividends that have been paid or declared during 2008 and 2009. So there's 2 years of dividends in arrears. So you're gonna do $0.9 per share of dividends times 60,000 shares times 2 years. You want to check how much do I have left of cash dividends to declare. So I still have 198,000. So now I'm going to go to the next step, which is the current year preferred share dividend, which is going to be basically the same thing as what we did here, the 54,000. And then the balance left over is going to be given to the common shareholders. So it's going to be the 306,000 minus what was given to the preferred shareholders. So that gives a balance of $144,000 for the common shareholders. And then for C, if the preferred shares are cumulative and fully participating, you're going to do the same thing here for the preferred shares. So you're going to want to check, do I have dividends that are in arrears? Yes, calculate them first. Then you want to check, okay, what is my current year preferred share dividends? Calculate it first. And then what is left over? Is going to be distributed between the preferred and common shares weighted equally. So my book value of my preferred shares is 600,000. And my book value of my common shares is 900,000. So my leftover of 144,000 is going to be split weighted equally. So for the preferred share is going to be the 600,000 divided by the sum of all the book value. So that gives a dividend of 57,600. And then for the common shareholders, you're going to take the leftover balance of 144,000 times the book value of the common shares divided by the sum of both book value. So it gives a dividend of 86,400 for the common shareholders. So you can see, like, from the 3 scenarios, what's the impact to the common shareholders, since whatever the features of the preferred shares are going to directly impact what are the returns for the common shareholders. So that's why they kind of bear the most risk in a sense, because they can't really predict what they're going to get as dividends.
Florence?
Yeah.
You calculated this based on the book value, but can you also calculate this based on the number of shares? Is that going to be the same thing?
Yeah, it's going to be the same thing.
Okay, thank you.
No problem. And then for question 4, it's about diluted EPS. So I'm doing diluted EPS only because I think it's more complicated than basic. The only thing that's going to be missing from this problem is how to calculate the weighted average common shares amount, because it's going to be given directly. If you want to check how to do that, you can see Q4 from chapters 15 and 17 from winter 2022, or final review from last semester or any semester before that. So for the question, at the end of 2012, the records of Great Accounting Solutions, Inc., which reports under IFRS, showed the following. They had common shares authorized 500,000 shares, issued and outstanding 200 shares. Average market price in 2012 was $14 per share. A 10% common stock dividend was distributed to shareholders on November 1st, 2012. A 5% non-cumulative preferred stock, Class A, 10,000 shares, par $100. This is really complicated to say out loud. And each convertible into 7 common shares outstanding throughout the year. So you have one class of preferred shares here. Then you have a 6% cumulative and non-convertible preferred stock, Class B, another class of preferred shares here. There is 20,000 shares, a par value per share of $100 outstanding throughout the year. Then you have bonds payable Series A, 5%, $100,000 at par. Each $1,000 bond is converted to 27 shares of common stock that is due in 2026. And then you also have another type of bonds payable that is 7%, 500,000. Each $1,000 bond is converted to 80 shares of common stock due 2025, and there is a book value of bonds payable at the end of 2021 of 550,000 to yield 6.5%. So a lot of stuff going on. You first have preferred shares Class A. Which are convertible into 7 common shares. They have a dividend of 5%, and they are non-cumulative. And there is 10,000 common shares per 100, so the book value is 10,000 shares times $100. Then you have preferred shares Class B. They are convertible into nothing. They have a 6% dividend rate, and they are cumulative. And they have a book value of 20,000 times 100 of 2 million. Then, so that's it for the equity. Well, you also have your common shares, I guess. Common shares, which have a book value of 200,000. Well, it's not given, but you have 200,000 outstanding shares. Then in your liabilities, you have a bonds payable Series A, which is convertible into 27 shares. You also have bonds payable Series B, which is convertible into 80 shares. So that's all that's going on right now. First, they're asking us to determine the basic EPS for the company for the year 2012. What else it says in the problem? It says that dividends on all shares were declared and paid during the year. Options Series A, there's also options. Okay, options. Oops. Options A, which if exercised, 10,000 common shares can be purchased for $15. And there's option B, which 21,000 shares can be purchased for $12 each. Average tax rate is 40%, and the net income after tax was $302,000. So first, the basic EPS for the year. So you want to find what is the net income available for common shareholders. We know that the net income for 2012 was the $302,000. Then we want to find what is the dividends for the preferred shares that was declared during the years. So we first had the dividends for Class A. And that is 5% of 10,000 shares times $100. So this is the book value of the shares that was here. So that gives us 50,000. And then there's also the dividends for Class B. The reason I'm including both and not just the cumulative is because dividends were declared for the whole year. Dividends on all shares were declared and paid during the year. If that sentence wasn't there, or if they said that there was no dividends that were declared and paid for during the year, the only amount that I would include in the calculation would be for the cumulative preferred shares. So it would be in this instance for preferred share Class B. So A wouldn't be included. The amount for preferred shares Class B is 6% of the book value. So 20,000 shares times $100. So that's 120,000. And then if I do my net income minus my dividends on preferred shares, I get the net income that is available to common shareholder. Shareholders. Then I want to find what is my weighted average common shares outstanding during the year. And here is already given to us is the 200,000 shares at the end of the year. However, you might be asked to calculate it. So you get a list of transaction, and then based on the transaction during the year, you find what's the outstanding amount. Like I said, it's not going to be covered in this problem, but you can look at like past tutorials for chapter 15, 17, or for past final review, and you're going to see how it's calculated. And to find our basic EPS, you're going to do the 132,000, so your net income divided by the number of shares, and it gives us a net EPS of 66 cents per share. Then they ask us, show in a well-formatted schedule the income effect, share effect, and the incremental EPS for each of the mentioned securities that is convertible into common shares. Rank each security by order of its dilutiveness and indicate if it is dilutive or non-dilutive for purposes of calculating the diluted EPS. So we have 5 securities that can be converted into shares. We have our preferred shares Class A, we have our bonds payable, and we have our options. First, I'm going to go with the 5% convertible preferred shares. And for each of them, I want to find what is the income effect, what is the share effect, what is the incremental EPS, and what is their rank. Then once I've done all of that, I can go ahead and calculate the diluted EPS. But we first need to assess like all of these things for each of the securities. So when you're looking at convertible preferred shares, the income effect is the dividends that you won't have to pay if they get converted into common shares. So right now, for Class A, you would have to pay, like if the dividends are declared every year, $50,000 in dividends. But if they get converted into preferred shares, that $50,000 is no longer going to the preferred shareholders, they're going to common shareholders. So it increases the income available to common shareholders by $50,000. So my income effect, whoops, is the dividends that you don't pay to the preferred shares. The share effect is if it gets converted, how many more shares are going to be issued? Common shares are issued. So share effect is only looking at the common shares. You're not looking at the preferred shares impact, only common shares. And in this case, for this security, each share is converted into 7 common shares. So they have outstanding 10,000 shares. And each share can be converted to 7 common shares. So that gives us an increase in the number of shares of 70,000 shares. So the incremental EPS is going to be your income effect divided by the share effect. And it gives us a incremental EPS of 0.71. You want to look now, okay, compared to my basic EPS, does it increase it or reduce it? Basically, your 0.71 is greater than the 0.66. So if you were to do an average, it would increase your EPS. What we're looking at right now, we want to see which one would reduce my EPS. So this security is anti-dilutive. It's not going to be included in our calculation for the diluted EPS. Because if the preferred shares were to be converted, it would increase our EPS. And that's not really the information we're trying to show in our financial statement. We're trying to show what is like the worst EPS we could get if all our securities get converted. So that's it for convertible preferred shares. Then we're going to look at the convertible bond, Series A. For bonds, what you're looking at for the income effect is what is the interest expense that would be avoided if they get converted into shares? Because when you have bonds, you're paying interest each year. So if they get converted, that interest is no longer like booked into your income. So it increases the income again, and that income increase is going to go to the common shareholders. So for income, it's the interest net of tax that you want have to pay. So to find the interest, if you're looking back at pre-midterm stuff, you're going to use your interest rate, which in this case is 5% because it was issued at par, times your maturity value, no, times your book value. In this case, it was issued at par, so it's $100,000. And then you want it net of tax, so it's going to be 1 minus your tax rate, and the tax rate is 40%. So it would, if the convertible bonds are converted, it would increase the income by $3,000. And the number of shares is going to be the number of bonds times the number of shares that can be converted into. We have, they don't tell us how many bonds they have, but we can calculate it by taking the value of $100,000 divided by the value of each bond, which is $1,000. And then you do times the number of shares they're converted into, which is 27. So it would increase the number of common shares by 2,700. Then we calculate the incremental EPS, which is $1.11, which is the same thing as the preferred shares. It's going to be anti-dilutive because it's greater than our basic EPS. So here, just for reference, my calculation was 100K times 5% times 1 minus 40%. And here, it was 100K divided by 1K times 27. Then we're going to look at our other convertible bond. And we're going to look at the same thing. What is my interest expense that I won't have to pay? And how many shares would be issued if they get converted? So here for my interest expense, we're going to look at my book value. The book value at the end of the year is, so here they weren't issued at par, so you have to look carefully. Here it's 550,000. And then my interest rate is the 6.5%. Your 7% here is your coupon rate. And then I do it net of tax. So it is an income effect of $20,000. So I did the 515K times 6.5% times 1 minus 40%. And my share effect is going to be, now you're going to look at the maturity value of 500,000 that divided by the value of each bond, which is $1,000, and then times the number of shares that can be converted into, which is 80. So if the bond's getting converted, they're going to issue 40,000 more shares. This was 500K divided by 1K times 80. The incremental EPS is 50 cents. So this is dilutive. It is dilutive because it's lower than my basic EPS. Then we're going to look at the options. So options A. When you're looking at options, you want to see what would be the impact of the number of shares that would be issued if the options are exercised. For the question, wouldn't we need to find the carrying value at the end of 2012? Let me check because it might be a typo on my end, but yes, you're right. You would need to find it at the end of 2012. But it might be me that typed the 1 instead of the 2 when I was doing the question. Because yes, you need to find the carrying value at the end of 2012, but they wouldn't ask you that in the final. Fall 2012. Okay. Question 5. Yeah, so I did a typo. It should be at the end of 2012 here, but we can't calculate it together. I'm just afraid it's going to become NC dilutive if we do it, but we can do it. So your book value at the end of 2011 is 515. How can we set it up? Do 2015. When were they issued? I don't think we have enough information to calculate it because we don't have the how long it is and like how many interest period there is in the year. So if you're given, mind you, this is a typo error from my end. It was supposed to be 2012 here. If you're given in your problem all the info to calculate the value at the end of 2012, you calculate at the end of 2012, and that's what you're going to use to calculate your income effect. But it's just on my end. I didn't check it up. But also, they're not going to ask it for the final because you're not tested on it. You're not tested on chapter 14. So it should be given to you like straight ahead. So don't break your brain if like it's ambiguous in the question. So yeah, convertible bonds B was dilutive. For option A, you want to calculate what is going to be the share effect if the options are exercised. There's never income effects when you're looking at options because it only impacts the number of shares that are going to be issued. And because of that, options are the most dilutive. It's always, yeah, they're the most dilutive because it's going to be always 0. But what you want to see is, are they going to be exercised? For example, for option A, the option price is $15 per shares. So they can exercise their options and they can buy the shares for $15. But you want to look at what is the market price at the end of the year. Would they exercise the options? The market price at the end of 2012 was $14 per shares. So it was lower than the price on the options. So why would they use the options to buy the shares if they can go on the market and buy them for $1 cheaper? So options A is never going to be exercised. So you're not going to include it in your diluted EPS calculation. Because it would never get exercised at the date of the financial statements. The value of the shares might change in the future, but that's what you're going to look at next year or at each quarter when you issue your financial statement. You want to exercise your options because and then for option B, we want to look at the same thing. What is the strike price on option B? And for option B, it's $12. And the market price is the same. It's $14. So they would exercise it, right? Because it's cheaper than to use the option than to go on the market. How to calculate the number of shares? You want to think of it as how many more shares can they buy for the same amount of money with their options than if they went on the market. So let's say I have $100. I want to go on them and I want to buy the shares. If I have a option price of $1, I can buy 100 shares. If I go on the market and the market price is $2, I can buy 50 shares. So my share effect would be 50 shares because I can buy 50 more shares than if I didn't have the options and I went on the market directly. How you're going to calculate it, you're going to first find what is the total value of the shares that are going to be purchased with the options. Which is the number of shares that they can buy. In this case, it's 21,000 times the strike price of $12. And then the total value of shares with market. So for the same amount of shares, so 21,000 shares, if they went on the market, it would be $14. So they would buy the same amount of shares for $294,000. The difference between the two is 42,000, and then that amount is going to be divided by 14, the market price. There's a bunch of different ways you can get to it. So my share effect would be 3,000. You could also do this divided by 14. Yeah, so that's one way to calculate it. You find the total dollar value for the same amount of shares, and then the difference between the two divided by the market rate. Another way you can do it is you find this amount and then you divide it by the market rate of 14. So that means that for the same amount of money, they would be able to buy 18,000 shares. And then here you bought 21,000 shares. So you do 21,000 divided minus, 18. So that means that they were able to buy 3,000 more shares. That's the two way you can find your share effect. Your incremental EPS for option B is going to be 0. So it's the most dilutive. We went through all the financial securities that the company had, and now we're going to rank them. We're going to take out option A from the rank. We're going to take out the anti-dilutive securities from the rank. So we're just going to rank our convertible bonds B and our options B. The rank goes from lowest to highest. So my rank 1 is going to be my option B because it's the lowest. And then my second rank is going to be convertible bonds B. And that's it for requirement B. For C, they're asking us to calculate the diluted EPS. So now we got everything set up. So that part is not the hardest. I think the hardest to find out what the income and share amount are. So to find the diluted EPS, you're going to put here your income effect, your share effect, and then EPS. You're going to start from your basic EPS. So the income that we used to calculate our basic EPS was the 132,000. And the number of shares we used was 200,000. And that gave us an EPS of 66 cents. Then we want to add our rank 1. We want to add its income effect, which is 0, and then the share effect of 3,000. And then we want to add our basic EPS and our rank 1 together to get the new EPS. So now it's an EPS of 65 cents. It's lower than our basic EPS. So we continue. It's still dilutive. Because it's lower than our basic EPS. We keep going, and then we're going to look at our rank 2. The income of our rank 2 was 20,000, and the share effect was 40,000. We're going to add it to our previous EPS that we calculated. And then we're going to find that EPS for this one, and it's going to be 63 cents. It's lower than the previous one that we calculated, so it's still dilutive. And because we have no more other securities that were dilutive, that's going to be our diluted EPS calculation. So that's the final answer. But let's say that here you didn't notice that that one was anti-dilutive when making your rank, and you used it in the calculation of your diluted EPS. A way you can, so let's say you ranked it 3rd, right? Because it's the highest. If you would have added it to your calculation here, you would have added its income effect, its share effect. Then you would have done the same thing here. You add it to your previous EPS. And then you would have calculated the new EPS. And then you would have seen that it increased. So rank 2, it was 0.63. I add my rank 3, and now it's 65. So it increased. So now it becomes anti-dilutive. Even though it's smaller than your basic EPS, it's not smaller because of this impact. It's smaller because of these two here. So you wouldn't have taken this one as your diluted EPS, you would have taken the previous one as your diluted EPS. And that's it for chapter 15 and 17. Any questions? So we can either take a small break right now, or I do chapter 18 and then we take a small break after chapter 18. If you want to, it's up to you guys. I don't mind. Okay, I think we'll go through a chapter. No, we'll take a break because chapter 18 is kind of very heavy in material, and chapter 19 and 20 are a little bit faster. So we're gonna have chapter 18. We can take like a 5-minute break after, and then there's gonna be like an hour left afterwards. So we can come back at 3 for chapter 18 and the problems. If you guys have any questions, you can put them in the chat and I'll answer when we come back. Chapter 18, I think it's like the hardest chapter in your class, especially if you haven't done business tax yet. It's like hard to like wrap around. Hopefully like it helps, the tutorial helps on how to solve it and how to understand like what's going on. Basically, you want to find out how to account for income taxes. In previous classes, all you would do is your net income times the tax rate. And that's only allowed under ASPE. Under IFRS, you have a different method to account for it. And that takes into account the difference between tax and accounting regulations. So when you're doing this chapter, you're going to be looking at 2 income. The accounting income, which is the one you've been looking at in your financial accounting classes, and the taxable income, which is what you look at when you're in your tax classes. The accounting income is determined according to IFRS or ASPE. It's your income before tax on the income statement, and it's used to provide information to users of financial statements. The taxable income is determined according to the Income Tax Act. It's found in the tax declaration of the company, and the amount it's used to determine how much tax the company has to pay to the government. The difference between financial accounting and tax is that under financial accounting, you're looking at transaction under an accrual basis. So for example, I received a paycheck on January 5th, 2021 for the work hours I did in December 2020. If I were to do my journal entry, I would include that paycheck in my 2020 income statement because I did the work in 2020, not in 2021. Under tax, you're looking at the transaction on a cash basis. So that same paycheck under tax would be included in your 2021 tax declaration because you received the money in 2021. So there's a difference, right, of a year between the two. So that difference is going to be accounted for in your balance sheets in income statement in 2020. So the impact would be there in your 2020 income statement. There's also a difference where under tax, there's some expenses that are not permitted and that you would expense under financial accounting. That's just straight up from the Income Tax Act. For example, dividends from taxable Canadian corporation would be included in your accounting income, but wouldn't be included in your taxable income. Proceeds on life insurance policies carried by the company on key officers or employee. Fines and penalties, golf and social club dues. Expenses related to the earning of non-taxable revenue. There's more, but those are also differences that happen. So we come to 2 types of differences, permanent differences and temporary differences. Permanent differences are the expenses that are not allowable under the Income Tax Act. So these differences are never going to be allowed. So they're never going to be reversed if you want. And you're going to understand the reverse when we look at temporary differences. So these differences are because of the cash versus accrual method. So if we go back to the paycheck, you have a difference in timing because at the end of 2021, when I'm doing my income statement, there's no difference, right? I received my cash at the beginning of 2021. I did the services at the end of 2020. So at the end of 2021, well, I guess in 2022, that difference is completely reversed because on both sides, the transaction happened. So they're temporary. Within time, eventually, tax and accounting will agree on that difference, and you won't have to adjust for it in your financial statements. For permanent differences, when you're looking at problems, you're not doing any journal entries for them because you're not going to be accounting for that difference in your financial statements. And to know that it's a permanent difference in your problems, you can look for non-deductible for tax purposes, non-taxable, or only a percentage is tax deductible. Basically, under tax law, it's not allowed. For temporary differences, there's a few examples, but the best way to find that it's a temporary differences, you're going to have like the amount under accounting, and then they're going to say that's what it should have been under tax. If you have both accounting and tax in the same sentence or same like paragraph, you should be saying, okay, that's a temporary difference because I see what it is in accounting and what it should be in tax. Some examples for revenues are installment sales, subscription sales, rent revenue, royalty revenue. And under expenses, you have your depreciation versus CCA, and CCA is the depreciation, but under tax laws. Warranties, lawsuit accruals. If we take an example for rent revenue, you might be paying on the first of the month for to rent your apartment, but or maybe like 3 months in advance for companies or a year in advance, but the service hasn't been provided yet. You need to live in it for a month, a few months, a year, for it to recognize the revenue under accounting. Under tax, the revenue is taxable as soon as it is received. So if you receive the full rent for the full year on January 1st, then that is completely included in your taxable income. Whereas under accounting, it would only be included when the service is provided. Your current tax expense is the amount of tax that you're going to pay to the government for the current year. So for we're in tax season right now, so it's the 2022 amount of tax that you would pay to the government for the 2020 year. How you're going to calculate it, you're going to start from your accounting income. You're going to add or subtract all your differences, so permanent and temporary, and then you get your taxable income. You're going to use your tax rate to find your current tax expense. So kind of similar to how you saw it in your previous financial accounting classes. The only difference is you're reconciling your accounting income to taxable income. It increases the taxable income. So here you're going to add your differences when either you're adding revenues that weren't included in your accounting income before, or you're removing expenses that were included in your accounting income to get to your taxable income. So cash that you received, but you didn't book it as revenue under accounting, or cash that you didn't pay, but that you booked as an expense under accounting. And then it decreases the taxable income when you're removing revenues that were included in your accounting income, but that shouldn't be included in your taxable income. So for example, you booked a revenue but you didn't receive the cash yet. That shouldn't be included to get to your taxable income. Or you're adding expenses that weren't included in your accounting income. So you paid something out, but you put it as a prepaid, for example, in your accounting income. So it's not included in it. And it should be included under taxable income. There's the taxes payable method that is only allowed under ASPE, and that's basically the method that you've seen in previous financial accounting classes where you take, no, sorry, it's not the same thing because you're taking your taxable income times your tax rate, and that gives you your income tax expense, and that's it. So your income tax expense is the amount of tax that you owe for the year, and then you don't really account for all your temporary differences in the rest of your financial statement. You're only calculating how much money I owe to the government. So that's only allowed under ASPE. Under IFRS, you're gonna have to use the deferred tax method. Under ASPE, it's named the future income tax approach, but it's the same thing, just different names and different account names. But if you understand the logic, you'll be able to do both the same way. So for the deferred tax method, I'm going to use deferred tax method because that's what comes to mind the most easy. But just mind you, everything I'm explaining right now is the same thing for the future income tax method. So for the deferred tax method, you're going to adjust for the temporary differences for their effects in the future in your financial statement by either recording an asset or a liability. And the second leg of your journal entry is going to go in your income statement as either an expense or a benefit. So the goal is that your deferred tax expense, so the impact of your temporary differences, plus your current tax expense is equal to your accounting income minus the permanent differences times your tax rate. It's a complicated calculation, but you don't have to really memorize it. It's not the case under the taxes payable method, so the one that we saw just previously, since we are not going to record the deferred tax expense. We're only recording the current tax expense. So you'll know that you have a deferred tax asset if the differences, the temporary differences, causes the company to pay less taxes in the future. So that means your taxable income for this year is greater than your accounting income. So you're going to be paying more taxes this year as a result of your temporary differences. But in the future, when they reverse, you're going to be paying less taxes as a result of the timing differences. For the deferred liability, it's the reverse. You're paying less taxes this year, but you're going to be paying more taxes in the future when the temporary differences reverse. So your taxable income is smaller than your accounting income. So I'm not sure if you're allowed a cheat sheet or not, probably. You can put on your cheat sheet, asset, my taxable income is greater than my accounting income. And liability, oh, okay, great. So on your cheat sheet, I would put this. Asset, taxable income greater than accounting income. Liability, taxable income is less than my accounting income. So when you're looking at your reconciliation here, if you sum all your temporary differences together, well, forget what I just said. If your accounting income is less than your taxable income, you're going to have an asset because the impact causes the taxable income to be greater this year, but when it's reversed in future years, you're going to be paying less taxes. And then if your accounting income is greater than your taxable income, you're going to be paying less taxes this year, but when they get reversed in future years, you're going to be paying more taxes. So it's a liability. You're going to be owing more money. A little rule of thumb to know between the two. For the expense accounting versus what you actually paid tax, if your expense is smaller than what you actually paid, it's going to be a liability. If the expense is greater than what you paid, it's going to be an asset. And then for revenue, If your revenue is greater than what you collected, it's going to be a liability. And if your revenue is less than what you collected, it's going to be an asset. These are examples, but we're going to see them in the problems, but you can look through it on your own if you want to see some different examples of situations. Now that this is out of the way, from year to year, you can have changes in tax rate if the Tax Act changes. When a change of tax rate occurs, there's going to be an impact on the existing deferred tax accounts in your financial statement. That difference is going to be recorded immediately as an adjustment to the deferred tax accounts in the period of the change. So what that means is if in 2020, I recorded my deferred tax account at a 30% tax rate. In 2021, the tax rate changes to 35%. I'm going to want to increase my deferred tax account by 5% to bring it to the same tax rate as 2021. You're going to, because your deferred tax account are supposed to reflect the future. So if you're using the previous tax rate, you're not actually reflecting the correct reversal of the journal entry. So you're not really taking into account the impact of the 5% tax rate change. If the tax rate for future year changes in the same year that you're doing your journal entry, when you're going to be booking your deferred tax accounts, you're going to be booking them using the future tax rate if you know it, because you already know that in the future, that's going to be the tax rate that my temporary differences might reverse to. But if you don't know what the future tax rate is, you book them at the current year tax rate. And then when it changes in the future, if it does, you're going to account for you're going to adjust your account for the difference. Then you can have loss carryovers. So if your taxable income for 1 year is a loss, you're not going to be owing any money to the government for that year because, well, you don't have any income to calculate your tax on. So under tax law, it allows the amount of loss to be applied to taxable income from previous and future years to reduce the amount of taxes owed or to get a refund from the government. So you can carry back your taxable loss from 3 previous years. So if I made a loss in 2022, I could carry back that loss to any income I did from 2021, 2020, and 2019. And I can carry forward that balance up to 20 years in the future. So if I make income, if I owe tax in the next 20 years, I can apply that loss to it. As normally, you want to apply that taxable loss first to your furthest year you can apply it to. So for example, I made my loss in 2020 and I had an income in 2017, then I would want to apply that loss to 2017 because next year it won't be available. I couldn't get a refund from the amount of taxes that I paid in 2017. It would now be 2018, the furthest back I could apply it to. And then, yeah, you can only apply it if you had income. So if I didn't have any income in 2017, then I couldn't apply to it. But if in 2018 I had income and I hadn't applied my 2017 loss on it, I could apply my current taxable loss on it. Don't think too hard about this part because you're going to see it in business tax if you haven't taken the class already. How we're going to account for it is if a loss is carried back, it's usually applied against the earliest available income, yeah. And it's going to be applied against the taxes that were paid in the previous year. So you're probably going to get, well, you're going to get a refund for the taxes that were paid in the previous year if you paid taxes. So if your amount of loss is greater than your income in 2019, you could use the full amount to get the full refund of the taxes that were paid. If it was smaller, it would only be a portion of the taxes that were paid that could be refunded. Okay, and then after you're looking at your previous 3 years and you're like, okay, I still have a leftover that I could carry forward. Like I got my refund for the 3 previous year. I could apply it to future years. Then you're gonna book a journal entry and you're gonna book a deferred tax asset. It's a deferred tax asset because you're gonna be owing less money in the future. And that's it for the theory. I find that the best way to know how to solve chapter 18 is by practicing. And sadly, my version of the book, the problems weren't that great. I'm hoping with your new version that they're better. But I couldn't tell you. I haven't seen the new problems that they are giving you. But if you practice past finals, you're gonna see that the question kind of go back. Oh, it's not. Yeah, that's what I thought. All the questions from the past finals are very, very similar for chapter 18. They're gonna ask you to do basically a question that's similar to question 5, which is a reconciliation between your accounting income, taxable income, and then you do the journal entry or some sort of variation to it. And then they're gonna ask you a question about carry forward and carry backward a transaction with like a change in tax rate. Change in tax rate can be tested here, can be tested here, depends. But it always comes back to the same thing, and you always see the same type of expenses and revenues that are tested for the temporary differences and also for the permanent differences. So once you do 2, 3, you're gonna get the hang of it and you're gonna get better. So if chapter 18 is a struggle, practice as much as you can. And whatever you're like bugging on, I would put it on your cheat sheet since you're allowed. So if there's a type of revenue that you're always bugging on the temporary difference, note it down on your cheat sheet so you know that if it comes out at the exam, at least you have that to look. Also, just as a reference, just in general, if you're doing your problems and there's always the same thing that you're struggling on, that should be on your cheat sheet. All right, so that was my little advice for the cheat sheet. Also, you might want to take the one your friend did for your cheat sheet. It can be good if you're like missing time and you don't have time to do it, but try and do it because it's really useful because you're kind of re-seeing the theory of the class and what you're struggling on when you're doing your cheat sheet. So you're kind of like studying at the same time you're doing it. And also you're not going to be lost during the exam trying to find what you're looking for in a cheat sheet. All right. For question 5, Home Use Products Inc. using IFRS provided the following information about its first 3 years of operations. In its first year of operations, the company used installment sales to promote its products. The company reported $4,000 in installment sale gross margin for the period. It did not have any installment sales for the next 2 years. Home use cash collection pattern on the installment sales was 15%, 25%, and 60% in the first year, second and third year, respectively. Home use uses the straight line depreciation for book purposes and recorded $10,000 in each of the first 3 years as depreciation expense. For tax purposes, it recorded $17,000, $12,000, and $9,000 of CCA in each of the first 3 years, respectively. Home use uses the allowance method to recognize bad debt expense for accounting purposes and recognize $5,000, $7,000, and $6,000 of bad debt expense in each of the 3 years. For tax purposes, it was permitted to deduct only the actual account receivable write-offs, actual losses incurred. Accordingly, deductible amounts were $0, $4,600, and $6,500 of bad debt expense in each of the first 3 years, respectively. Home use recorded a $6,000 contingent litigation liability in year 1 for accounting purposes. This was disallowed for tax purposes and which would be deductible only when the liability is paid. In year 3, it paid $1,200 of this liability. In each year, the firm received $1,000 as municipal subsidy given to a new startup enterprise. These are non-taxable subsidies. Home use reported accounting income before tax of $18,000, $13,300, and $26,500, respectively, in each of its first 3 years. Assume that home use operates in only one tax jurisdiction and its statutory tax rate in year 1 was 35%. However, during year 2, the government enacted a change in tax rate to 40% for year 2 and following years. So requirement 1 is to prepare a reconciliation between financial and taxable income for each of the first 3 years and the amount of income tax payable in each year. And then for requirement 2 is to do the journal entries for year 1 and 2 only. So we're going to start. I'm going to set up my table. So I'm going to have my year 1 adjustment, year 2, and year 3. So when you're looking at your reconciliation schedule, you're always first looking at your accounting income before taxes. So if here we're getting our accounting income before tax, but if it was given after tax, you have to take off the tax from there because that's what we're trying to calculate. It shouldn't be included. So my accounting income before taxes for year 1 is 18,000. Year 2 is 13,300 and year 3 is 26,500. I'm taking them from here. Then after I get this, I want to take out my permanent differences. So those are the expenses or revenues that are not allowed under tax laws. In this problem, there's only one, and it's the the municipal subsidy given to new startup enterprise. How I know it is that it says here that these are non-taxable subsidies. So under accounting, you would have included it in your accounting income, right? So it would have increased your accounting income. So your accounting income without the municipal subsidy would be 17,000 in year 1 because the municipal subsidy is $1,000. So you want to get here in your taxable income, you want to remove its impact. So you want to get your accounting income to 17,000. So you're going to remove $1,000. And you're going to do the same thing in year 2 and year 3 because it's the same amount. And that's it for the permanent differences. And this one, the contingent litigation liability is a little bit tricky because it says disallowed for tax purposes. So my trick kind of is wrong. But because they give us the amount that is paid out, so the amount of cash that was paid, and also because contingent litigation liability, normally they come to a close, it is a temporary difference. So after you get your permanent differences, you're going to get your temporary differences. And for this one, go one situation at a time. So they're normally like everything related to installment sales are going to be grouped together in your problems. So if we start with the first paragraph, which is about installment sales, basically what it says is that during the first year under accounting, they reported $4,000 in installment sales. So they increased their revenues by $4,000 for the installment sales. That wasn't paid out yet by their customers. They didn't receive cash. They just accrued it because they provided the services. They receive cash each year, this percentage of the sales. So what we want to do is we want to remove the impact of the $4,000 in year 1, and we want to replace it by the cash that was paid each year. So technically, you should have a revenue of 15% of 4,000 in year 1. And then year 2, it's 25% of 4,000 because that's the actual cash that was received. And that's what we're looking at when we're looking at taxable income. So if I want to remove my installment sales, under ACCO, so under accounting. So I want to remove its impact from accounting. What we did is we booked $4,000 and increased our income by $4,000. To remove its impact, we need to remove the $4,000 from our accounting income to get to our taxable income. So we remove $4,000. In year 2 and year 3, they didn't book anything regarding installment sales, so there's going to be no adjustments to do on the accounting side. On the tax side, we want to see what was the actual cash I would receive, and that cash is what we want to include in our taxable income. So in year 1, they received 15% of $4,000 in cash. So we want to include that amount to get to our taxable income. So we're going to include $600. In year 2, they received 25%. So that's what we want to include in our reconciliation. And then in year 3, they received 60%. If we sum them all together, it gives us $4,000. So when I was saying it's a temporary difference, it's because eventually our accounting and our tax side are going to increase. There's going to be no more difference between the two. At the end of the 3 years, there's no more difference between cash and accrual basis. The total of the temporary difference was reversed at the end of year 3. You could have problems where the temporary difference hasn't been fully reversed, and that's normal and that's okay, but it's just a great way. This example is just a great way to show you what is the temporary difference, why are we saying that it's going to get reversed eventually. So that's it for installment sales. Then for the second paragraph, it says that home use uses the straight line depreciation for book purposes and recorded $10,000 in each of the first 3 years as depreciation expense. For tax purposes, it's recording $17,000, $12,000, and $9,000 of CCA in each of the first 3 years, respectively. So we're not really talking about cash here because it's depreciation, but there is a difference in how the calculation is made under tax laws. And under tax laws, you call it a capital cost allowance, CCA. And basically, under accounting, it's kind of up to management to decide what is the useful life of the asset, on how, like, what's the method you're going to use for depreciation, if there's if there's a value at the end of the depreciation, all these things, it's up to management. But under tax, it's too much judgment. So for the assets, there's like categories of assets, and all the assets that fit into that categories are going to be depreciated the same way. So regardless if my building in one company and I have a building in another company and there's a third company that has a building, they're all going to be depreciated the same way. So the impact on their tax that they owe to the government or whatever it is, I don't remember, but whatever it is, it's going to be the same regardless of the judgment of the management in each companies. That was very fast, and it's okay if you didn't understand. Basically, it's just not calculated the same way. So that adjustment is going to be in all your problems. So what you want to do is you want to remove your depreciation expense from your accounting income, and then you want to put in your actual tax depreciation expense to get to your taxable income. So to remove the effect of the depreciation expense, an expense is subtracted to get to your accounting income, right? So because it was subtracted from it, you want to add it back to cancel its effect. So I want to add back my $10,000 per year that was booked as an expense. If I do a little like table here, I have my revenue. Let's say it's $100. I have my depreciation that was $5, and then I have my income. Let's say there's only that in the company. I want to cancel the effect of my depreciation. So to cancel its effect, I want to add it back to get back to my $100. So that's why I put it as a positive. So my line here is basically this here. But then I want to actually subtract the tax depreciation to get to my taxable income. And that amount is going to be 17,000 for year 1, 12,000 for year 2, and 9,000 for year 3. I'm back. So if I take back again my example, I'm back to $100 of income. I want to add the actual impact of my CCA to get like to my taxable income. So I want to take off, let's say, $10 to get to my taxable income. So now my taxable income is $90, but that $90 only reflects the tax depreciation. It doesn't reflect my depreciation under accounting because that impact was completely removed when I added back the amount of depreciation. Hopefully it makes sense. For the third, it says that home use uses the allowance method to recognize bad debt expense for accounting purposes and recognize 5,000, 7,000, and 6,000 of bad debt expense in each of the 3 years. For tax purposes, it was permitted to deduct only the actual account receivable write-offs, so the actual losses incurred. Accordingly, deductible amounts were 0, 4,600, and 6,500 of bad debt expense in each of the first 3 years, respectively. So here, the adjustments that we're going to do, since it's also an expense, it's going to be the same logic as what we did here. We want to remove the impact under accounting, and we want to add the impact under tax. So to remove the impact of an expense, we want to add it back to our income. So I'm going to add back 5,000. I'm going to add back 7,000, and I'm going to add back 6,000. Then to take into consideration my actual write-offs, I'm going to, well, in year 1, there's none, so 0. In year 2, I'm going to remove the 4,600. And in year 3, I'm going to remove the 6,500. Then the fourth one is that they recorded a 6,000 contingent litigation liability in year 1 for accounting purposes. This was disallowed for tax purposes and which would be deductible only when the liability is paid. In year 3, it paid 1,200 of this liability. So we're going to have our contingent litigation expense and paid contingent. So tax. So we want to remove the, what was it? The 6,000 expense that we booked in year 1 by adding it back. And then we actually paid it in year 3 and we paid 1,200. So we want to remove it from year 3. This one doesn't reverse all the way as the other ones don't either. It's okay. It's going to get adjusted anyways in the income statement in year 3 because you didn't pay it. So you don't have to worry about that. But basically, you just book the actual amount that was paid for a contingency. Your gain or loss are going to be also a temporary difference, but it's too far for Chapter 18. And that's all your temporary differences because this was a permanent one and the rest are not temporary differences. So we get at the end to your taxable income. So if we add our accounting income, permanent differences, and temporary differences, that gives us our taxable income. Then we want to take our tax rates to get to our current tax expense. tax rate in year one was 35%. Year two, it was 40, and year three, it was also 40. And then our current tax expense for each year's was these amounts here. Oops. So that is the reconciliation schedule. Any questions before I jump onto the journal entry on like the how to do it? Oh, sorry, I can't hear you properly. It might be on my end. Wait, talk again.
Can you hear me now?
No, I can't really.
All right. All right. Sorry.
Okay, no problem. Yeah. Yeah. So it was change in year two. We took it into account here for change rate, but that's going to be impacting our journal entries when we book them. I'm going to talk about it when we're doing our journal entries. Because we used it to calculate our current tax expense, but when we're going to calculate our DTA and DTL, it's going to impact it. Yeah. No worries, no worries. So she was talking about the change in tax rate, and we're going to see how it impacts how it impacts our journal entries. Basically, when we're going to be booking our temporary differences, we're going to book them at the year one tax rate because the tax rate was only changed during year two. So during year one, when you're booking your journal entry, you don't know what your future tax rate is. So you can't really predict it. So you're going to book it at this year tax rate, so year one tax rate. When it's going to change in year two, you're going to do an adjusting journal entry to correct it, to increase it by 5%. That's a problem for like in 10 minutes. So we're going to first do our journal entries for year one. So the first entry that you should be doing is the entry for your current tax expense. So you have a current tax expense of 6,000, and then let's say it hasn't been paid yet, you're going to put it as an income tax payable. If it has been paid, then you put it as cash directly, but it's kind of rare that it's going to be paid like right ahead. Then we're going to be booking journal entries for all our temporary differences. You're not booking anything for your permanent differences because there's no future impact. So first, for my installment sales, how do I know it's a DT or DTL? You're going to take the sum of your accounting and tax adjustment. And if your sum is a negative, like in this case, it's a liability. If it was positive, it would have been a DTA. The reason is, if we're only looking at this adjustment, it will come and reduce your taxable income. But when it gets reversed, like we see in year two and year three, it increases your taxable income. So in year two and year three, if it was only this adjustment, you would be paying more taxes. So you owe more money to the government in the future because of how it was set up in year one. So you're setting it up first as a liability, and when it gets reversed in future years, you're going to come and reduce that liability. So it's the deferred tax liability. And then the other leg of your transaction is always going to be impacting your income statement. So in this case, it's the deferred tax expense. And how you're going to be booking it is you're going to do the sum of your accounting and tax adjustment times your tax rate. In this case, like I explained, we're using year 1 tax rate because we don't know yet that in year 2 the tax rate has changed. So think of yourself, you're the accounting clerk. You're not going to be an accounting clerk, but you're the CPA booking those journal entries. You can't predict what's in the future, so you just book it at this year's current rate. So it would give you a deferred tax liability of $1,190. Then we're going to do the same thing for our second adjustment, which is the depreciation versus CCA. We're going to be looking here. For year 1, the difference between the two is negative. It's a negative 7,000 here at the bottom. So I'm going to be booking a liability. The amount that I'm going to be booking is going to be the sum of my differences. The sum of my adjustment, which gives me a difference of 7,000 times my year 1 tax rate. Then I'm looking at my bad debt expense. If I sum the two together, I give a difference of $5,000 positive, which means that it is an asset. The other leg will be a benefit. So it's going to come and increase your income tax benefit. You can also put expense as a credit. Honestly, I don't think they would be too picky about it. And to record the amount that you're going to book, you take your accounting and tax adjustment, again, times your tax rate here. And then you have your litigation. And then you sum your accounting tax adjustment together. It's a positive of 6,000. So it's also going to be a deferred tax asset. The amount is going to be 6,000 times 35%, so 2,100. Yeah. So you can use this when they ask you to record all your journal entries. If they are only asking you, like, I don't know, to only like determine what the deferred tax asset or liability is, and they're not asking you to do all the journal entries, a quick way to check what it's going to be is you just sum all your temporary differences together. My sum is $600. So it's going to be a DTA. I sum all of these together, and then I do times my tax rate. So I would book on my statement $210 as a deferred tax asset. If you want to verify it, we can do it here by doing minus my liabilities. Oops. Minus this plus this plus this. And that gives me the same amount. So what I did is I minused when it was a liability because it's like a credit. And then I did plus when it's an asset, and it gives me the same thing. I didn't add the tax rate into this calculation here because it's already taken into account when we did our journal entries. So if the sum of your temporary differences is negative, it's a DTL. And if the sum of your temporary differences is positive, it's a DTA. So that's it for year 1. We're going to do year 2. So for year 2, first thing that happens is that there's a change in tax rate. So it changed to 40% in year 2. So you want to come and adjust all your deferred tax assets and liability accounts to reflect that change in tax. Because we calculated already, it's going to be a little bit easier to find it. So it's an increase of 5%. So you're going to increase your deferred tax asset account by 5%. It's an asset because the balance of year one is an asset is positive. Deferred tax benefit. And what you can do, you can either divide this by year one tax rate and do times 5%. No, you shouldn't. Yeah, you can do that. Or you can take the sum of your year one and do times 5%. I find that a little bit easier. So I did 5% because 40% minus 35% is an increase of 5%. So this is I didn't do this times 5% because this is calculated using year one tax rate. So I want to remove the impact of the year one tax rate to find like the pre-tax amount. Then the rest are similar journal entries to what we did in year one. So we're going to find first our current tax expense to income tax payable. That's going to be the 5,000 here. Then we have installment sales. We're going to see if it would increase our liability or reduce it. So here the impact is positive. So technically, if it was the first year, it would record a DTA. But because we already set up a liability, we're going to come and reduce our liability. I'm telling you this, but it really doesn't matter if you book an asset because you forgot to check year one, because at the end, you're only booking an asset or a liability, so they all net out each other. So it's fine. So what did I say? It was now an asset, right? Yeah. So it's not an asset. So I'm gonna just switch out my two accounts here. And then the amount is gonna be the sum of your accounting and tax adjustment times the current year tax rate. We know that it's 40% also in year three, so we're going to use the 40%. No, I didn't use this right thing. Here. For depreciation versus CCA, we'll see if it increased again our liabilities, which is the case. You have a net impact of minus 2,000. So we're going to do minus 2,000 times our tax rate. For bad debt expense, the impact is still an asset, so it's going to increase our assets. So it's going to be the sum of, the sum of our two adjustments times the tax rate. And then for the contingent, for the litigation, there's nothing that gets booked because there's no impact in year two. What did I do? Okay, this. Okay. And I think, yeah, that's it for question 5. Any questions on reconciliation between accounting and tax. Okay. For if you can put them in the chat if there's anything or talk. For question 6, it's about a carry forward and carry backwards with a loss. So Congress Limited reported the following amounts and information for 3 years ended on December 31st as follow. I'm just going to copy them from my solution so it's easier to use. Taxable income loss in the 2 years prior to 2016 was 0. Any changes in tax rates are not enacted until the year of the tax change. Tax rates beyond 2018 are not expected to change. West's management is confident that it is probable that the company will be able to use the losses carried forward. First, prepare the journal entries to record only the loss carried back and/or loss carried forward for the years 2016 to 2018. Journal entries for the timing differences related to property, plant, and equipment features are not required to be made by you. So we're not going to be recording our temporary differences with depreciation and CCA. All we're looking at is carry forward and carry backward. So in 2016, there was a taxable income. So there's nothing really that we're going to book, especially since there was no loss in the 2 years prior to 2016. So there's no balance that we could have carried forward to 2016. So there's no journal entries required. For 2017, however, we have a taxable loss of 1.3 million. That 1.3 million can be applied to our 2016 taxable income and can also be applied to our 2018, well, in the future up to 20 years. We don't know yet that in 2018 we have a taxable income. So what I'm going to want to do in 2017 is first get a refund for the taxes I paid in 2016. And if I still have a balance left over, I want to carry it forward for the next 20 years so I can use it against any income that I have. So I'm first going to book the journal entries for the refund and tax I'm going to get from my 2016 tax refund. The current tax benefit. The amount that I'm going to get back is basically the taxes that I paid in 2016. So in 2016, taxable income was 480,000 and my tax rate was 25%. So I would have paid in tax 120,000. That's what I get back from the government. My balance of loss that I can carry over is going to be my $1.3 million of loss minus my 480,000 income from 2016. So I'm also always looking at my taxable income before tax, because as you can see here, the tax rate changes. So if I was just looking at it as on a taxes payable receivable, I wouldn't get like the right balance. So I still have $820,000 that of loss that I can carry forward for future years. So I'm going to set up a DTA because I'm going to be paying less taxes in the future because of that. The amount I'm going to set up is going to be my $820,000 here times my tax rate of 30%. No, of 33%. Wait, are the tax rates? Any change rates in tax are not enacted until the year of the tax change. Okay, so it's going to be times my 2017 tax rate, because I don't know yet that it's going to change in 2018, because the changes are only made during the year that the tax rate is changed. So it would only have changed in 2018. So I'm going to carry forward 246,000. And that's it for 2017. In 2018, well, I have a change in tax rate, so I have to account for that. So I'm going to increase my DTA by 3%. So I'm going to do this times 3%. Again, I'm looking at it pre-tax amount because the 246,000 here takes into consideration the tax rate of 2017. So I just want to look at it without the tax impacts to increase that amount by 3%. Yeah, so the balance of 820,000 was found by taking my taxable loss of 2017 and removing 480,000 from it. Basically, because that amount was used when we're doing our refund of the tax of 2016. So I still have a loss of 820,000 that I can use in future years. So here I did 820K times 3%. Then I have an income in 2018 and I don't want to pay tax in 2018. So I'm going to use my amount of loss from 2017 and apply it to my 2018 income. So I don't owe any taxes to the government, but also they don't owe anything back to me. It's like 0-0. Then no one owes anything to anyone. So I'm going to come and reduce my assets. And then my expense. So see, you're still like booking an expense for your tax, your current tax. It's just that instead of being current, it's different. And the amount that you're going to book is, since the 820K loss is greater than my income for the year, I'm going to book the full amount of taxes that I would have paid if I didn't have the amount of loss from last year. If the amount was different, then I would have not paid the amount up to of taxes on the amount up to the balance of the carry forward. I hope that makes sense. And then I would only have paid taxes on the amount left over of income that isn't covered by my carry forward amount. So let's say it was $1 million here instead of 820,000, then I would have only paid taxes on the difference between 1 million and $820,000. Yeah. Okay, but back to the problem for 2018. The amount of taxes that you're not going to have to pay is going to be 190,000 times 33%. And then if you want to calculate what the balance left over is, it's going to be your previous year's balance, so the 820,000. And you're removing from it the 190,000 taxable income from 2018. So you still have $630,000 of loss that can be used in the next 19 years. I'm not booking any journal entries for that balance because it was already booked in 2017 here. And then you also booked the impact of the change in tax rate here. So we're already reflecting that balance in our in our balance sheet. This was if 100% of the loss can be carried forward. In requirement 2, it basically says, how would our amounts here change if only 60% of the amount could be carried forward? So they're only expecting to have income up to 60% of their loss in the next 20 years. Because you need to report the actual amount you think you're going to be using. So in the first requirement, we thought that we could use the full amount. So we're going to record the full amount. But since in requirement 2, we only think 60% can be used. So you only want a provision for the 60% in your books. So for 2, only 60% can be used. So 2016 doesn't change. There's no journal entries. For 2017, you're still going to be able to get 100% back of taxes that you paid in 2016 because you already paid it. Oops. You already paid it, so you already know that that full amount can be paid, can be received from the government. You already earned that income. Now, to figure out what's going to be the amount that you can carry forward, instead of being 100% of the 820,000, it's only going to be 60% of this amount. So you can only carry forward 492,000. So when you're booking your entry here, you're going to be booking it based on the 492,000 times the 2017 tax rate. And then in 2018, then in 2018, when there's going to be the change in tax rate, it's going to be based on the 492,000. And that's what's going to increase by 3%. And then because that amount is still greater than the taxable income from 2018, you're still going to be able to not pay any taxes in 2018. So it's going to be the same journal entry as here. It's just now that your balance at the end of 2018 is now 302,000 instead of the 630,000. And then requirement 3, for this section, ignore the amount of taxable loss given in the problem for 2017. Instead, now assume that Congress decided that it was possible all of the losses would be used within the carry forward period, and that in 2017, they correctly set up an asset of 244,000 to recognize this loss carry forward, and after carrying back the maximum loss possible to 2016. Also assume the 2018 tax rate was known in 2017. How much was the taxable loss in 2017? How much was the accounting loss in 2017? So for requirement 3, basically what they're giving you is the DTA of 244,000, and they want you to work backwards to get your taxable income and your accounting income. So your DTA was set up using the 2018 tax rate because it was known in 2017 that because in 2017 they already knew that the tax rate was going to be 33%. So to find your wait, did I get it? Yeah, so this was booked at 33%. Okay. It's given. Okay, and then the other adjustment that was given was that they still were able to apply their loss carry back from 2016. The amount is the 480,000. So these two amounts together give you your taxable loss. Wait, I made a mistake here. That's why it looked funny. Okay, so your 244,000 here that they give you is the DTA. That DTA was set up using the 33% tax rate from 2018. So your balance that was used, basically the amount pre-tax, is going to be the 244,000 divided by 33%. Okay, that makes more sense. And then you want to, that gives you your taxable loss. And then you also want to find your accounting income. And you had some timing differences, which I guess were the same here as here. So you want to add them. You want to add back your temporary differences. Depreciation positive. So you add it, so you want to remove it to get to your accounting income, which is a loss of 1.1 million. So here I removed it because I want to find this first line here. So to get from here to here, I needed to subtract it. And that's it for chapter 18. So yeah, so practice as much as you can. You can send me questions during the week if you're doing problems, not just on these chapters, but and you're not understanding something. I'll be answering. And then right now there's only chapter 19 and 20 left, and they're quick on the theory. The problems can be a little bit more tricky. Chapter 19, not really. But chapter 20 can be a little bit more tricky, so we'll be spending more time, and I think we should finish in time for 5. Okay, so for chapter 19, we're talking about pension plans and how a company accounts for them on their income, on their financial statements. So a pension plan is an arrangement in which an employer will give payments to an employee after they retired for services that the employee provided when they were working. So I don't know, you work at your job and your employer set up a pension plan for you and they contribute 2% of your pay, or you have a certain amount at the end when you retired. Basically, that amount is going to be added to your income when you retire. It's basically like money that you get when you retire. You're not working anymore, but that's accounted for when you're working at the company. I'm just questioning myself if I explained it correctly. Basically, the company kind of has to predict how much they're going to pay to you in the future when you retired. And that has a lot of uncertainty in it. You don't know what's going to happen. I'm going to retire in probably like 30, probably 40 years at the rate it's going. So in 40 years, like how much would I need to retire? How much would my employer contribution be worth? There's 2 types of contribution plan. There's defined contribution plan and defined benefit plan. I probably got them mixed up when I was talking. Defined contribution is the most common now. Basically means that the employer at each pay period are going to give you a certain amount. And that's the amount that they're going to book in their financial statement. That amount is going to be invested in whatever you chooses when you set up your pension plan. And then based on how those investments go, that's going to be the amount that you get when you're retired. So the employer, apart from paying you that contribution every pay period, they don't bear really any risk because like they paid their contribution, they don't really care how it goes when you're retired. They already did their part. So the risk is on the employee and on their choice of investment. That's the most common one now. But in the past, what was used was defined benefit plan. And that instead of having like each payroll, you have a certain amount that goes in your pension plan for blah, blah, blah. The employer would say, when you retire, you'll get $5,000 per month until you die. But the employer had set up that pension plan when you were working. So they had to predict how much do I need to put in my investment now so I can pay all my employees $5,000 per month when they retire? And also they would bear the risk because like, what if like their investments didn't go so well and they lost a bunch of money, they still contractually have to pay out to their employee the $5,000 per month. On a side note, one of my clients at work we were auditing their pension plan, and they switched during the year from a defined benefit plan to a defined contribution plan. So you can see that it's really like companies are changing now to defined contribution plan because it's less risk for them. It's also less complicated accounting wise to account for it. So in this class, we're really focusing on how to account for defined benefit plans because they're so complicated. Here, it's just like, you set up your expense, you set up your payable. When you pay it, you remove it, and then it credits your cash. It's not that different from a regular payment to an employee. Defined benefit plan has a bunch of accounts. You're going to have to set up an asset account for your investments. You're going to have to set up an obligation for the amount that you owe your employees in the future. You're going to have to account for your contribution in those accounts. You're going to have to account for the employee contribution if they can contribute. There's also, so there's a bunch of stuff that goes into it, and that's the focus of this chapter. Yeah. So a liability is going to be recorded on the employer statement, and then an asset is going to be reported for the required amount that has been contributed. You have past service costs, and past service costs are, for example, with one of my client, there's a change in the pension plan, and they now say like, okay, well, employees that were in service for the past 5 years, we're going to recognize those past 5 years into your pension plan. So we're going to recognize your 5 years of experience when we're calculating what we owe you instead of just starting at zero, like as if you would have just been employed by us. I guess that's for contribution, but it's the same thing for benefit. Interest. So if there's payments are required to be made in future period. Okay. For defined benefit plan, another thing that's important is that the contributions, well, the investments are not going to be monitored by a company. It's a third party that's going to monitor it, a bank, for example. So the employer says, I'm going to give you $5,000 per month when you're retired. So I'm going to put money in a trust, which is in a third party company, and they're going to be the ones that are going to kind of be in charge of my investments based on the choices of the company. So it's not the company like putting in the money in like a share and then they decide which shares. It's like a plan with a third party. And also their benefits are vested. So even if, well, they can be vested or not vested. If they are vested, that means that if an employee decides to leave the company, they still have the right to the amount that the employee puts aside for them when they were working. And if they're not vested, well, they lose everything. Okay, so if you work more at the company, you're gonna get a bigger contribution when you retire. And the objective of accounting for defined benefit plan is that the expense and liability related to these plans are going to be recorded over the accounting period where the employee is working at the company. And the only difference between ASPE and IFRS is that if there's remeasurements of the obligation of the asset, it's under ASPE it's going to go to net income, but under IFRS it's going to go to OCI. It's because ASPE there's just no OCI. Okay, that explain. So the accrued benefit obligation is basically going to be the liability, so what they owe to the employees, and that's going to be estimated by actuaries. So they're not going to ask you in your exam to like calculate it, like how much they should put aside. And then you have planned assets, which are the investments that are made to fund the obligation. So your obligation, everything, all these accounts here go into it and have an impact on the calculation. You don't need to know the definition for this class, but just know like where everything goes. Also, I'm not sure if you're going to be given, I guess yes, but like the table where you like kind of plug everything. I hope for your sake that you're going to be given it. But if not, if you know that current service cost, well, it's an expense and it goes in my obligation. So you can kind of recreate that table on your cheat sheet. Here I put a definition for everything, but just know current service cost is expense and it touches your obligation. Past service cost is an expense, touches your obligation. Interest costs, so there's interest that accrues on your obligation. So it's an expense and it goes in your obligation. Actuarial gain or loss on your obligation. So this is if the actuaries think that there should be a change in the value of your obligation. Well, that change is going to be expense under ASPE, OCI under IFRS, and then it's going to go in your obligation. So basically gains or losses on obligation. Your benefits paid to retiree is going to come and reduce your obligation because you're actually paying it out. So you're doing your part of the obligation. And then you have your planned assets. So here you can think of the investments that you make to make sure that you have enough money to pay out the obligations to the retirees. So what goes into it is the expected return on assets. So how much money you think you're going to make on your investments. The employer and employee contributions. So during the years, employer are going to put money into the obligation, and employee have also the possibility to contribute. So that goes and increase your planned assets. The employer contribution is a credit cash, and employee contribution in benefit under ASPE, it's like a reduction of your expense. Actuarial loss on investments. So before we had the expected return. So if the return are not actually that, then that goes also in your planned assets. It's like your gain or loss on investments. And it's expense under ASPE and OCI under IFRS. And then you have the net benefits asset liability account, which is basically just the difference between your planned asset and your obligation. If your obligation is greater than your planned assets, it means that your pension plan is underfunded because you owe more than what you've invested. So it's going to be a liability. And if your obligation is smaller than your planned asset, then it's overfunded because you have more investments, you have more money to pay out than what you actually owe. And this was the table I was talking about. Hopefully it's given to you in the exam. You should probably ask your teachers if they haven't said, if it's going to be provided. But basically, a positive here is a debit and a negative is a credit. So here, if I'm just looking at my current service cost, it's going to come here as an expense, so as a debit, and then the other leg of my transaction is a credit for my obligation, so it comes and increase my obligation. At the end of the year, you fill out everything. Maybe there's some lines that don't have anything that can happen. And then you're going to get your expense entry. So how much do I need to book in my income statement regarding the pension plan? You're going to have any gains or losses if you're under IFRS. If you're not under IFRS, this column goes into expense here. And then cash, so how much you paid out. And then your ending balance of the pension plan. So that's it for the theory. The doing problems, I don't know why this chapter, I found it really complicated, but honestly, it's just plugging numbers in the pension sheet. Like I said, hopefully you have it. So I already have it here. I'm just gonna copy and paste it here. Ugh. Okay. I hate when it does that. Doesn't copy properly. Okay. So for question 7, in late 2000, Funky Waves Limited established a defined benefit pension plan for its employees. At the inception of the plan, it was decided that both the interest expense accruing on the obligation and the expected returns on the plan assets would be computed only on the balance existent at the beginning of the year. Further, such balances would be adjusted for any changes affected by transaction occurring at the beginning of the year. For the year 2015, the following information was provided to you by a trainee accountant for the company. So first, Funky Waves follows IFRS procedures and ended its accounting year on December 31st. So that means that we're going to be booking stuff to OCI if there's gains or losses. The discount rate as well as the expected rate of return on plan asset was set at 5% per year. So my rate is 5%. The accountant did not remember the beginning balance of the DBO or the plan assets. He did recall that the interest expense for the year was $136,500. So that I can already booked in my net interest cost. So that's my interest expense for the year. So that means that it's basically my interest times my beginning balance of my obligation. Then he also complained that the investment committee was, in his opinion, not doing a good job as the actual returns amounted to only $57,330, which resulted in an annual return of a poor 3.5% rate of return. So what that means, actual returns, it's the actual return on investment. We don't have our beginning balance of plan asset, but basically 3.5% of our beginning balance of plan asset is equal to actual return of 57,000. So we can use these numbers here to find our beginning balance. And this amount will also be useful to find out what is the actual loss on investment, because it's our expected, which is going to be here, minus our actual. So we have our actual return, which is $57,330. And then our actual rate is 3.5%. So that means that my plan assets at the beginning of the years were this divided by this, 1,600,000. So that's what I'm going to be putting here. Then my expected return on assets can also be calculated. Yeah, Elizabeth? Oh, are you guys looking?
I think we look at the
You're looking at
answers.
this? Ah, I see. Okay, I'm going to switch screens. Oh, that means you didn't. Okay. Oh, that's weird. Screen 2, screen 3, share. Can you now see the answers? If I type, there should be like the questions and the answers. If not, I'll just move them. Okay, thank you. So I'll restart then. So if we go back to here, they follow IFRS. This was all like blah, blah, so it doesn't really matter. So if we go back to here, they follow IFRS. So we'll be using the gain loss column. So for OCI. And then here we know that the discount rate as well as the expected rate of return was set at 5% per year. So the interest rate was 5%. And then the accountant did not remember the beginning balance of the obligation or plan assets. He did recall that the interest expense for the years was 136,500. So that amount can be plugged into the sheet right here. Then he also complained that the investment committee was, in his opinion, not doing a good job at the actual returns, amounted to only 57,000, which resulted in an annual return of a poor 3.5% rate of return. So the actual returns are calculated using our beginning balance of the plan assets. So using these figures, we can calculate what it is because we don't know yet. So I have my actual returns of 57,330. I have my actual rate of return, which is 3.5%. And then my plan assets at the beginning were the 57,000 divided by 3.5%, so 1.6 million. I think that's where we left off. Then I can also calculate my expected return on assets because we now have our beginning balance. Is that too small if I put it like this? Okay, because now we have our beginning balance and we also know what our expected rate of return was, which is 5%. So it's just going to be this times 5%, 81,900. This goes and increases my plan assets, and my interest cost comes and increases my obligation. Now, my actual return was 57,000, but my expected one was 81,000. I want my increase in my plan asset to actually be my 57,000 here. So my actual loss on investment is the difference between my expected and my actual, so that if we net them out together, I get my actual return as an increase in my plan assets. So what I would put here is my 81,000 minus 57,000. And then I want to put it as a negative. Because I want the net impact to be 57,000. The 24,000 is going to come as a gain. No. Debit is going to come as a loss in my OCI. Okay. Back to the problem. He then proceeded to read out a bunch of figures. 201,000 for current service costs. That goes and increase my obligation. 60,000 for past service costs. $312,000 paid to existing retirees. So that's gonna come and reduces my obligation and reduces my plan assets. And 240,000 received from the company as the annual funding for the plan. So that comes and increases received from the company. So it increases my plan assets. And since it's the company that paid it out, it's going to be paid out in cash. So it's going to come and reduce my cash. Upon quizzing him further, you also learned that the funding status at the beginning of the year reported an underfunding. So that means that my plan assets were smaller than my obligation. The plan assets were 60% of the defined benefit obligation. So this is 60% of this amount. So to find this amount, I'm going to be doing this divided by 60%, 2.7 million. And then my kind of like plug account is going to be the difference between the two, which is 1,092,000 as a credit. And where was I? Okay. In each alternate year, every odd year following inception of the plan, the actuary remeasured the defined benefit obligation arising from employee services and recommended that the plan amend its accounting figures accordingly. The actuary would also revise the estimate parameters based upon its latest estimate. For the 2-year period ended in 2015, the revised estimate for the DBO amounted to 2.9 million. So basically what they're saying is right now the balance of my DBO is this, but I want it to be this. So I'm gonna book a, well, in this case, it's gonna be a gain. Well, I'm gonna book the difference between the two in here, and then that is gonna come in here. So the difference between the two is $139,500. I want to put it as a negative to increase my DBO. So it's going to be a loss. So it's going to come as a loss in my OCI section. And that's it for the plugging numbers in this section. So now the total of my expense for the year is 315,000. The total of my OCI is going to be a loss of 164. I paid out 240,000. And so for my expense entry, it's your benefit expense remeasurement that goes in your net benefit liability. And then your payment goes into that account too. And then your ending balance should be the sum of all of these. And now to make sure that we didn't do any mistakes, your sum of your plan assets is all of this. And then if you add these two together, it should equal this. So if I add these two, it gives us this 131. Oh, here it should be a negative. Okay, so if you add these two together, it's 1.3 million. And then here it was 1.3 million. And then the last thing, well, the two last things to do the journal entries. So you're gonna have for your expense entry, pension expense, OCI, and then your net benefit asset. Just plug the numbers that you already have in your schedule. And then for your funding entry, again, you just plug the amount that you already have in your schedule. And then they ask what would have been the pension expense under ASPE, so the pension expense under IFRS is 315. We're gonna add the OCI portion, which is the 164. So that gives a pension expense under ASPE of 479,000. So that's it for chapter 19. Like I told you, hopefully you get the table here. I would be really surprised if you don't. But then after, just plugging in numbers, and if you're doing it by hand, be careful about like the plus and minuses. Plus is a debit, minus is a credit. And yeah, that's basically it. Any questions? Okay, so then chapter 20, last chapters, we're doing great. Leases. So leases is a contract. Yes, I can re-explain it, no problem. So we were given here in this requirement the actual return on plan assets. So we got an actual return of $57,000, and the percentage of return was 3.5%. Normally, how you calculate the actual return is you take your actual rate of return, the 3.5%, times your beginning amount of plan assets. But now we kind of got it in reverse. We got the answer as our data, if you want. So we can use the answer to get to our beginning plan assets amount. So how I did it, I basically just took the 57,000 divided by 3.5%, and that gives me my beginning balance of 1.6 million. Perfect. So a lease is an agreement between two companies, and basically given one company the use of an asset for a specific amount of time in returns of payments. So you're going to have the lessor, which are the person that are leasing out their assets. So I have a building, I'm leasing you out my apartment, one of the apartment, I'm the lessor. The lessee is the company that's going to gain the rights to use the assets. So you now occupy that apartment, you're the lessee. You have two types of leases, finance capital versus operating lease. A capital lease or finance lease is a lease that transfers all of the benefits and risk of owning the asset to the lessee. So it's as if they bought the assets on like the market. And then an operating lease, it's when the benefits and risks of ownership aren't transferred to the lessee. You need to determine if it's a capital or operating lease for both the lessee and the lessor. For the lessee, it could be capital, and for the lessor, it could be operating. So how to know if it's a capital, finance, or operating lease? Under IFRS, it's called a finance lease. For the lessee, what you're going to be looking at is if it's a short-term lease, so less than 1 year, or if it's less than $5,000 in payments throughout the year, then it's going to be a operating lease. If none of these criteria are elected, so the company has the choice to put it as an operating lease. If the company decides that they're going to put it as everything as a finance lease, unless the company elects to put it as an operating lease, and to elect it, they need to fulfill these two criteria. Under ASPE for lessee, it's one or more of these criteria are filled out, it's going to be a capital lease. So first, you have an option to repurchase the asset at the end of the contract. Or do you keep ownership of the asset at the end of the contract? Is the lease term at least 75% of the useful life? So if your asset has a useful life of 15 years and the lease is 14 years, then you have more than 75%. And is the present value of the lease payment at least 90% of the fair value of the asset at the date of the contract? So if one of these are met, it's going to be a capital lease. That's how to calculate the present value. For the lessor under IFRS, it's the same thing as for the lessee. So they have to elect, and it's either if it's a short-term lease or if it's less than 5,000 minimum lease permits per year. Or no, not per year, overall. And then under ASPE, for the lessor, it's the same requirements as what we just saw for the lessee. So these three criteria, and both of these needs to be fulfilled. So reasonably predictable payments. So they know that they're going to get all the payments that they're supposed to get. Like if the lessee is going bankrupt and the lessor knows, then it's not really reasonably predictable. And there's no uncertainties regarding future costs to be incurred. And that's all the theory I have, because the rest is really just like journal entries that we're going to see when we're doing the problem. So you're going to have to first determine, is it a capital lease or capital finance or operating lease? Then you book the journal entries for them based on the scenario that's given in the problem. I've put in the PowerPoint, like at the end of the 2 slides, like all the journal entries and how to calculate it, but best if you like practice it. So for the problem, question 8, Bridge Equip Limited, Bell, the lessor, agreed to lease a heavy-duty scraper on January 1st, 2015 to Montreal Engineers. Mel, the lessee. Both companies uses ASPE and both agreed to the terms stated below. The scraper had a 9-year life with a cost of $846,000 and a fair market value of $1,020,000. It would be leased for 7 years, after which the equipment would revert to the lessor. Bell had insisted that the residual value of $160,000 be guaranteed by Mel, and it was done. Mel amortized all equipment on a straight-line basis. The annual installments will commence January 1st, 2015. Both companies have a December 31st year-end. Bell is normally in the business of selling equipment outright to its customers. However, Mel was unable to get the required financing from its bankers. As Mel was a regular long-time customer, Bell decided to enter into this one-time special transaction. Although Mel has agreed to pay all executory costs directly to connected parties, Bell was yet not sure what additional costs it might incur in connection with this lease. It was particularly uncertain about legal costs and recovery of the equipment in the event of Mel going bankrupt. And finally, given the deteriorating financial condition of the lessee, Bell used a discount rate of 15%, which was considerably higher than normal rates applicable to such transactions. The lessee was aware of this rate and had agreed to it since it approximates its current incremental borrowing rate. Requirements. The first one discussed how this lease will be classified by each party. Be sure to indicate very clearly what classification applies to each company. Support your answer by identifying and stating the appropriate criteria for such classification. So basically, we want to see, is it a capital, because we're using ASPE, or operating lease for the lessee and the lessor. So the lessor in this problem is Bell, and they use ASPE. And the lessee is Mel, and they also use ASPE. For the lessor, the criteria that you want to look at are these two, they need to be fulfilled, and also the 5 that we're going to see for the lessee. So I'm going to check first, are these two fulfilled? Because if they're not, there's no point at looking at the other 3, because it's going to be operating. So first is there reasonably predictable payments? And given in this, normally if it's quiet, it means that yes. But in the problem, it says that Mel wasn't able to get the required financing from its bankers, deteriorating financial condition of the lessee. So they might miss some payments, you know, they're not looking so good financially wise. So this is not met because they might not be able to pay it all. So right ahead, I know it's going to be an operating lease. I can also look at the second criteria because it's also given no uncertainties regarding future costs to be incurred. Okay. Okay, great. And this is also no, because it says in the problem that Bell was not sure about what additional costs it might incur in connection with this lease. So they don't really know what costs are going to be incurred on their side for this lease. So this is also no. So because both of them are no, it's going to be an operating lease. But also if only one of them was no, it would have been an operating lease. For the lessee, we don't have to look at these two criteria. We're just going to look at the other 3, and only one of them needs to be fulfilled. Just going to put it here so I remember. So the first criteria is, do you have a bargain purchase option, or do you keep ownership at the end of the lease term? Answer for this one is no. There's no mention of that. 2 is the lease term at least 75% of the useful life of the asset. So the useful life of the asset is 9 years. And the lease term is 7 years. So 7 divided by 9 is 77%. So that's yes. So it's going to be a capital lease. We can also look at the third one, but just know during an exam, if this one is yes, just jump right to the next question because one of them is fulfilled. But I'm going to show you how to calculate this one. Is the present value of the minimum lease payment at least 90% of the fair value of the asset? So we're given the fair value of the asset. It's $1,020,000. We're not given the present value of the minimum lease payment, so we're going to have to calculate it. We know that at the end of the contract, there's going to be a residual value of 160,000, so I'm going to add it here. We also know that the interest rate is 15%, which is given here. We know that the lease term is 7 years. Just making sure. Yep. So now we can calculate what the payment is. So rate, number of period, present value, future value, and is it beginning or end of period? So when are the payments made? So the annual installments will commence on January 1st, 2015. So it's beginning of period. Oops, one. So it's payments of 200,000. Because we use the present value of the fair market value of the asset. If I do this times 7, nope. Basically, it's 100% of the fair value of the asset because that's what we use as our present value. If it's given to us, maybe you're going to have to calculate the fair value of the asset, but basically it's 100% here. Or they might give you both fair values and you just have to do like this divided by this. That's it for 1. 2, determine the amount of the annual installments which Bell has set for the lease. And that's basically what we just did. It's the 200,000 here that we calculated. For 3, prepare the lease-related journal entries on January 1st, 2015 in the books of the lessor and the lessee. So on January 1st, 2015, for the lessor, so it's an operating lease. So for them, it's not going to be seen as if they sold their asset, which would have been the case if it was a capital lease for the lessor. How it's seen is just lease revenue and lease expenses. So it's all booked through their P&L. So for them, on January 1st, 2015, they're going to receive some money for the lease. They're going to receive 200,000. That 200,000 is going to be considered unearned because it's for the year 2015. So they're going to book it at unearned, and at the end of the year, they can record it as a lease rental revenue. So they receive cash. They have unearned lease revenue of 200,000. And that's all we're booking for the lessor. For the lessee, for them, it's as if they acquired the assets, and they also now have to book an obligation that is of the same value of the asset. And they also are making the first payment to the lessor. So first, they want to book their lease equipment that they have now in their books. And that's going to be the fair value of the asset and lease obligation of the same amount. And then we have to record the payment here that was received by the lessor. So they're going to have to decrease their lease obligation because they paid it out. Credit cash of 200,000. And I'm booking this on January 1st because the first payment is made on January 1st. If the payment was made at the end of the year, they would only be this proportion here, this journal entry. And there wouldn't have been a journal entry here. Then for 4 actually, the journal entry at December 31st. So for the lessor, they're now gonna record the revenue. Same amount as what they've received. And they're also, since they still have the asset in their books, they're also gonna have to depreciate it. And the amount that they're going to depreciate it is going to be 846,000. So that's the cost in their books divided by 9, which is the 9-year life of the asset. For the lessee, they're gonna have to book an interest expense that's gonna go in their obligation. No, that's not yet gonna go into their obligation. So the interest expense on the obligation for the year 2015. And they're also gonna have to book a depreciation expense for the leased assets. We're gonna do a little schedule here. Because it's at the beginning of the year, the payments, it's a little bit funky how the journal entries are made. Okay, so I've put here period 0, which is basically the first day of the contract. There's two things that are happening. You're setting up your obligation of 1,020,000, but you're also paying out your first lease payment. That lease payment is going to come and reduce your obligation. Nothing has, like there's no time that has spent yet, so you have no interest expense. Your interest expense is only going to be calculated at the end of the year. So your obligation after January 1st is now 819,000. Your minimum lease payment is, you're going to pay it 7 times. So 1, 2, 3, 4, 5, 6, 7. Your interest expense is going to be on December 31st, 2015. So let's say January 1st here. That's going to be 15% of your previous balance of your obligation. And then what's going to come and reduce your obligation is going to be the difference between the two. Whoops. We have a guaranteed residual obligation. What that means is that at the end of the lease contract, the lessee is guaranteeing the lessor that the value of the asset is going to be 160,000. So they're going to pay out 160,000. No, sorry. They're going to pay out at the end of the lease 160,000 on top of the minimum lease payment here as a guarantee that the asset is okay. So this is going to come as my last payment. And as such, my obligation is now 0. So for the journal entry on the 31st of December 2015, you're going to want to book your interest expense, which is here, and also your depreciation. For the interest expense, it's only going to be payable on January 1st, so the day after. So it's going to be set up as a payable on December 31st. And then the depreciation expense for the lessee is going to be the 1,020,000 minus your guaranteed residual value divided by the lease contract time, so divided by 7. Then on January 1st, 2016, for the lessor, it's going to be same thing as what they booked here. For the lessee, it's going to be a little bit different. You're going to remove your interest payable from your books because now you're paying it. You're going to be paying cash to the lessor, and then you have an obligation here. You're going to reduce your obligation. Your interest amount is going to be the same as what you booked at December 31st. Cash is going to be your minimum lease payment of 200,000, and the difference between the two is going to be the reduction in your obligation. Yeah, that works. Okay. Then requirement 6, assume that the fair market value of the scraper returned by mail on December 31st, 2022 is 138,000. Prepare the journal entry to record this transaction in the accounting book of the lessee. So on December 31st, 2022. So the fair market value is 138,000. Okay. So you're gonna first have to remove your lease obligation, your asset and accumulated depreciation from your books. So accumulated depreciation, your obligation, and then your leased equipment. Your leased equipment has a book value of 1.20 million. Your obligation, the only thing that's left over is the 160,000. And then the accumulated depreciation is going to be your depreciation amount that was here times 7. You can double check here. And then you want to book a loss or a gain for the difference between the fair market value of the asset and your guaranteed residual value. So since my guaranteed residual value was 160,000 and I promised it was going to be it is 138,000 and I promised it was going to be 160,000. I'm booking a loss because I'm actually like debooking 160,000, if that makes sense. So my loss is going to be the difference between the two, which is 160,000 minus 138,000, so 22,000. And then finally, last requirement, regardless of your answer to question 1 above, assume for this question only that this lease had been classified as a sales type lease by Bell. Prepare the entry to record the lease transaction in the books of Bell on January 1st, 2015. So instead of being a capital lease like how we booked it, how would it have been if it was a capital lease? I said capital twice, but instead of being an operating lease, how would it have been if it was capital? So for the lessor, they would have to record a lease payment receivable. And it's a sales type lease. Basically what that means is that they're making some profit on the sale of the asset. So the fair market value of the asset is different than its cost. The cost of the asset is the 846,000, which was its book value here. The lease payment receivable is, okay. The lease payment receivable is basically the sum of all my payments here. Then I have a sale for the fair value of the asset. I'm reducing my inventory for the same amount as my COGS. And then I have unearned interest that you can either plug, like the difference between your debits or credit, or it's the sum of your interest here, 544,000. So that's how you would book it if it was a capital lease for the lessor. And that's it for the final review.